Good afternoon and welcome to the 14th annual Power Gala. It was great seeing many of you at last night's Honoree reception, and we're thrilled to convene the full industry for today's program. In just a moment, we'll be welcoming honorees to the red carpet. But before we get started, we have a special guest joining us to help us mix our signature cocktail of the evening, the Bourbon Bacao, sponsored by Bourbon LLP. Aaron, thank you so much for joining us today. So tell us, what exactly is the Bourbon Bacao?
Sure, Max, thank you. So this is it's a riff on a Manhattan, right? So with a Manhattan, you have whiskey, you have sweet vermouth, and then you have bitters. And so for this one, I thought that we would zhuzh it up a little bit, add a little bit of sweetness and a little bit of luxury with the amaretto. And then, you guys have to be up for a while and ready to party. So we're going to add in a little boost of caffeine with the coffee liqueur. So the Bacao just stands for all of the ingredients that are in there: bourbon, amaretto, coffee liqueur, Angostura bitters, and then we'll finish it off with an orange.
Sounds good.
I love it. Yeah. I should have undone the top for my bitters before we started, but I'll be working on that.
Don't worry, you can do it right now. There's nothing quite like doing a fresh crack on a new bottle of bitters. So if you all are ready to kick it off, we are going to go ahead and start with a mixing glass. If you don't have a mixing glass, you can grab the bottom of a cocktail shaker tin or a wide mouth glass, just like Max has there. Now remember, ice is always going to be the last thing you ever put in a cocktail because you want to be able to fully control that dilution. So I'm using this mixing glass here, and we are going to start out with adding really the underbelly, the star of the workhorse, if you will, of this drink, which is my bourbon. So I have here a pony jigger. A pony jigger, the sizes are 1.5 ounces on top, 1 on the bottom. If you have a standard shot glass, that's going to be that jigger measure, 1.5 ounces. If you don't have those particular materials, you can always grab a tablespoon. 1 tablespoon is equal to half a fluid ounce. So I'm going to start here by adding 2 ounces of bourbon into my mixing glass. Now, of course, if you don't have bourbon, or rye will do just fine as well. It will also yield a little bit more of a spicy cocktail. But I like bourbon because it's made with at least 51% corn, so it will be nice and sweet. So we've got our 2 ounces of bourbon in our mixing glass. Now let's go ahead and add in our supporting cast. So we're going to start out with our coffee liqueur. Again, that's that thing that'll keep you up and keep you going. And we're going to do 1/2 ounce of our coffee liqueur. I like using Mr. Black's cold brew, but you could also use Kahlua or any other brand that you like to use. So that's 1/2 ounce right here, right in to join our bourbon. Now, once we have our bourbon and our coffee liqueur mixing together, we're then going to add that little bit of decadence with that amaretto. We're going to do equal parts there, another 1/2 ounce of amaretto. So far we've done 2 ounces of bourbon, 1/2 ounce of our coffee liqueur, and 1/2 ounce of our amaretto. So I'll go over those just one more time: 2 ounces of bourbon, 1/2 ounce of coffee liqueur, and 1/2 ounce of amaretto. Now, to just kind of push us over the edge, we're going to be adding in a dash of Angostura bitters. So if you're a chef in the kitchen, you add things like spices to make sure that you can kind of kick those flavors to the next level. And that's really the job of Angostura in here. So Angostura will add a little bit of that bitter note, but also those beautiful notes of baking spices. Those peychaus will do just fine too, Max. So we are going to do 1 dash. Now, normally when people think, oh, 1 dash, that's just 1 shake. It isn't quite that simple. So what we're going to do is we're going to do 3 shakes of our bottle. Just make sure that little tiny, that metering top is on there. Otherwise, you're going to dump that whole bottle in there. So we're going to do a 1, 2, 3. Now let's add in probably one of the most unsung heroes of cocktail making, and that's our ice. So I'm going to take my ice and fill this up to above my liquid line. And what that is you just want to make sure there's more ice than liquid in your glass. So I'm going to keep filling and filling. That'll do it right there. So you see, here's my liquid and my ice goes right above it. Now I'm going to take my bar spoon. A bar spoon is made specifically to stir cocktails. It has this lovely spiralized handle, so it can easily turn in your fingers. But if you don't have one, a regular spoon, a chopstick, or even a butter knife will do just fine. If you have a bar spoon, we're going to take that convex outer portion of the spoon, place it on the inside, slide it down, and we're going to give it a gentle stir for about 30 seconds or 50 to 60 rotations. We want to get this nice and cold, but also add in a little bit of dilution. Dilution is the glue that holds all of those cocktail ingredients together and makes it a cohesive, new and exciting drink for us. All right. So now we're going to take our stemmed glass. I have a martini glass here. You could also grab a coupe or a Nick and Nora glass. And I am going to place my strainer in here, and I'm going to strain this out into my glass. Now, to finish our cocktail, we want to add a little bit of orange. That's our last O in the drink's name. So grab an orange, and you can take a knife, a Y peeler, or a vegetable peeler, and you're going to get a decently sized piece of just the peel, called the exocarp, or the outermost layer. Just this here. If you get some of the pith, that's okay. And what we're going to do is we're going to take that orange portion, place it down into the drink, and just give it a pinch. Now, if you wanted to be fancy, you could also do one of these and grab a match. Never use a lighter because you don't want this to taste like butane. Take that fire, and you can always put an orange peel in there. Also, who doesn't want fire, right? Now, to top this all off, nothing is quite complete without a garnish. A garnish is the accessory of our cocktail. And what I've done is I've taken a nice long piece of my peel and I have cut it into a rectangle and just kind of made it these little pieces on the side. You don't have to do this whole thing. You could just take your orange and your knife and take a nice long piece. And you can take the knife and, like I said, you can clean up the edges, or you could just do a little piece in the middle like so, and open that up and pop it on the side. Or if you wanted to go the fancy route, I have this nice big one, all nice and ready. And it has this lovely little movement to it. So it makes you feel like you're really fancy and out about on the town. And that, my friend, that is a Burden Macau. Cheers to you.
Cheers to you, Erin.
I totally screwed up on the orange part, but this, I panicked and I forgot. What?
It's okay. It's very forgiving.
Okay.
And this drink, it's kind of a grown-up version, if you will, of an espresso martini. That espresso martini is going to be a little bit sweeter, but this one is going to bring in a little bit of sweetness from that whiskey and that amaretto to kind of push it to the next level.
I'm definitely not going to attempt the orange garnish, but it looks delicious. Erin, thank you so much.
Thank you all, and have a lovely evening, and congratulations.
Cheers.
Well,
Cheers.
Cheers to you. Well, I hope you all have your Burden Bacows ready to roll, because we're now going to head over to the red carpets.
With Kathy Cunningham from Commercial Observer, co-deputy editor. And we are pleased to be joined by two legends of the commercial real estate business, Bruce Mosler and Peter Rigardi. Bruce, Peter, good to have you today.
That's great to be here.
I want to just start with one of the big pieces of news that happened in last week, and one that I think is a pretty interesting harbinger for what's happening in the real estate market. A $2 billion sale. Google exercised its rights to purchase at St. John's Terminal. What do you guys think that means? Peter, do you want to start?
Well, there's no question about it. That's just terrific news. And on the supply and demand side, we're not going to absorb enough space in this market without big tech signing on and committing to New York City. And I think the Google announcement, and I think there's some other, announcements or deals in place in the tech space that'll follow, that'll really endorse New York as a place they want to be. And it endorses our ability to be a great city and attract and retain talent. And that's the most important part of it, in my opinion.
Yeah, there's not much to add to what Peter said because very clearly during the course of this pandemic, we have been buoyed by big tech, by finance. The growth commitments that have been made in spite of the challenges of COVID have really reinforced the fact that, to Peter's point, this city remains the tech capital and the financial capital of the world. And the Google deal also says that from an employment perspective, from a future perspective, New York is the place you have to be. They're investing significantly above and beyond the acquisition of that building and the build out of that facility. So it's all good news on that level.
Definitely a pretty strong statement to make, and a really, like you said, a great one for New York City. You both said that. And more generally speaking, what are you seeing in terms of investment sales? Is now a good time to be a seller in New York City, would you say?
I'll start. Look, I think that from the investment sales perspective, there are silver linings at this moment in time. We're seeing some sales like this that really speak to the future of the market and how important New York is in the attraction of not only foreign, but now domestic capital and corporate capital. Look, I think very clearly we have work to do to see a total recovery of the investment sales market, but there are silver linings that I won't be specific, but you're going to see some additional announcements beyond what we just heard from Google that continue to reinforce the fact that capital wants to be and needs to be in New York City. So now it's not a function of volume. It's sort of like, as Peter alluded to before, we're not tracking vacancy rates right now. We're looking at a flight to quality. We're looking at which assets are seeing the increased activity and which assets are performing well under this market. And it's those assets that have been reinvested in and those assets that are coming out of the ground that can offer efficiency. So this is positive news on the one hand with Google, and there'll be more to follow, I suspect, in the fourth quarter of this year.
So, New York City has had a lot of success, new buildings, fantastic rental achievements, high credit tenants, all of that puts on the green signal for institutional investors to monetize the asset. So I think there's a lot of thought around that. There's been competition, right? I mean, who doesn't want to invest in, industrial, last mile retail, with the revolution in our country and in technology and buying possibilities. So that's always out there as competitive. But I agree with Bruce, of the major cities in America, New York is going to be the leader in this space.
Yeah, I mean, look, just to put numbers to it, there's been roughly $8.3 billion invested in all property types in the first half of 2021, and in New York, that number is going to grow. The fourth quarter is always the most interesting quarter in this city and around the country. But I think the bottom line is New York is and will always be the most important location from the standpoint of international investment and domestic investment, and that is because of the tendencies we've talked about before. It's this city continues to face challenges and overcome each and every one of them, and not just through COVID, but prior challenges. So I'm very confident in the future.
You've scintillated us with the new deals that are coming down the pipe. I mean, we're gonna have a lot to report on, Bruce. That's very,
I hope so.
You're a reporter. You always want to scoop, right?
Yeah, totally.
Their blood.
We get that.
I did want to dive into a little bit about what you just said, though. Obviously Google tech tenant, everybody's talking about tech, and I've looked at some of the deals that both of you guys have inked over the past year, and it is a lot of tech and a lot of fire tenants, and this was sort of what was leading the pack pre-pandemic. So I mean, did a lot of these tenants, have they readjusted their approach at all to real estate, or is it, is it just, the same as it was?
Peter, why don't you lead off and I'll come up?
So, you know, great question. I think a lot of that still needs to be answered. Will people work 3.5, 4 days a week? Will the people who have the choice to do that be able to keep assigned seating or not? All these things need to play out so we can understand footprints. But I think if you look at, different segments, the big US banks, their tech and ops divisions clearly have had a lot of success working from home. And I think we'll see less of them returning. I think the foreign banks and smaller banks are saying they want to be in the best space they can be and are probably looking to manage run rates by lowering their footprints and trading up to better spaces. Tech, what they're doing in New York is counter to what they've said. All we keep hearing about is tech putting off coming back to work in the office. Yet, we've seen and we'll be seeing more and more tech transactions. I had the opportunity to tour Deutsche Bank space the other day. We represented Deutsche Bank and Related at Columbus Circle. And it was just the most amazing space I think I've ever been in. And it has 2 private windowed offices in 1 million square feet of space. So things are definitely changing.
And so I'm just gonna bolt on to Peter's conversation and say this. I think we both agree that there's going to be a new ecosystem out there. And in that ecosystem, you're going to see maybe it's 15% or 20% or something in that range of the workforce that will work remotely. There'll be another part of the workforce that works 2, 3, 4 days a week, and that may depend upon your job specifically. But at the end of the day, there's a significant percentage of folks that want to return, that have to return to collaborate, because we do understand that collaboration creates a culture creates a brand, and companies value that proposition. And by the way, so do millennials and Gen Zers. They want to be around other people. That's how innovation occurs. And that's why I believe these tech companies continue to, in spite of, as Peter said very well, that they talk about pushing off the return, but in the end analysis, all the while they're taking more square footage. I also think we're going to see a different kind of office, and that's harder to talk to at this point, but we know that people want to bring their employees back to a new experience, something different, something more exciting. And we're going to see that as the architects continue to work with their clients and our clients to develop the workplace of the future. It's coming, and it's going to be different, and it's all going to be geared towards making the work environment a live, work, play, be here, throughout the evening to into the next. It's going to be different, but I think more exciting. The net is, I don't think the square footages will change significantly. They will, and in some industries more so than others. But at the end of the day, it's going to look different and feel different for the worker.
Absolutely. And in terms of fourth quarter pipelines, everybody I've spoken with recently is very excited about their fourth quarter pipelines. Seems to be a lot of activity, a lot of busyness. So curious to see or hear what you guys are seeing and what you expect from the fourth quarter.
Well, you just said it, so I'll
Sorry, still your line.
Look, I think Peter and I would both agree the fourth quarter is typically a very strong quarter for all service businesses, and this year will be no different. Now, I think we're also coming off of a year where there's been pent up demand. I think when COVID hit, clearly people were just trying to figure out what to do, how to recover, how to communicate with their employees. Technology was beginning to take off. And now the turn has been made towards we've got to get back to work. And so we're seeing significant commitments in the pipeline. And I think again, it's going to look different. There's a flight to quality. It's an overused word, but there's really no other way to describe it. And assets that are well invested in, reinvested in. So existing property that's reinvested in, and ground up new development is seeing a lot of activity, and the price point there is holding up. And those assets that don't get reinvested in are facing more challenges. But by and large, the pipeline for tenant commitment is significant this year, clearly as compared to last year.
Look, I think that the marketplace has different types of buyers and sellers, right? And, you know, certain buyers know what they want and they find it affordable. And as Bruce said, they want to make a statement and a decision to help bring their people back to the office because they need to be here. They want to be collaborative. And so those people will make the first foray of decisions. Some of them have already started to happen. And then I agree with Bruce, we're going to have a really strong finish. And then I think it could be a little bit of a wait and see in the beginning of the year as other buyers start to say, okay, this space is left. They'll look to their left and they'll look to their right and they'll see who else is out looking. And they might see some advantage for the occupier and try and, you know, negotiate a little bit more than maybe this first wave will do between now and the end of the year.
Yeah, and I'll just add to what Peter said, because as ever, he's looking forward beyond your question. And I'm glad he did, because I do think people will take stock. And I do think that at the end of the day, there'll be lessons learned in what the first wave has done. And in those lessons learned, there'll be adjustments made. That's the nature of the beast at the end of the day.
Right. A constant evolution from
Yes,
where we are today.
On that note, I think we're actually out of time. But yeah, I know it went so fast.
Oh, we get extra minutes like in a soccer match? Come on.
Yeah, overtime.
We'll do overtime privately. You, me, Kathy, Bruce. All right. Well,
having fun. So there we go.
Yes, it goes fast when you're having fun. Bruce, Peter, thank you so much.
Thank you.
Thank you so much.
It's a pleasure. Bruce, be well. See you later.
Be well, Peter. Thank you so much.
Thank you.
You all.
It's our pleasure to welcome Untitled Payne and Melissa Birch to the red carpet. Untitled, Melissa, thank you so much for joining us today. It's great to see you.
It's great to see you, Kathy.
So it's been a bit of a whirlwind, bit of a roller coaster the past 20 months, but you know, I'd love to hear, you know, what you're seeing in the market today, and also how's your return to work plan going now that we're 20 months into the pandemic?
Melissa, do you want to start?
Sure. Thanks, One. I'll jump in. It's first of all, it's great to be here out on the virtual red carpet with One and with you, Kathy. You know, the return to work has been such a welcome change. We are at Lend-Lease now back on a voluntary basis. Our official start back in the office has been pushed back to January. But what you find, and what I think is really interesting, is how many people are really coming in on a voluntary basis, really looking for that creativity and collaboration and connection. So I'm really enjoying being back in the office with my team, and we have a lot of work. So we're excited to sort of be rolling up our sleeves together and you know, returning thankfully with you know, vaccinations to some amount of normalcy in the office.
Fantastic.
Yeah, we too have returned to the office. We're on a hybrid schedule. And I chided some folks on my team earlier on when they would say return to work, because it would suggest that for the past year and a half, we haven't all been, you know, kicking butt. We're working remotely from home, but we have returned to the office on a voluntary basis as well, like Lend-Lease, and we're Clarion Partners will be revisiting our strategy, our hybrid strategy starting December. But most of us are in the office 2 to 3 days a week. And I love the way someone put this, actually as the CEO of our parent company, so Franklin Templeton is our parent company. We had a town hall yesterday where Jenny Jones made comments, and she said, you know, really as we're thinking about the role of the office, and Melissa is going to have some really great insights here, but the role of the office, she likes to think about it as basically it was presence with purpose, right? So as employers, as leaders in our firm, I think I would suggest that the more traditional notion of where, you know, work has to happen in the office needs to be challenged. And as we incent people to come back into the office, there's really a purpose. So as I'm going to the office, for example, I'm making sure that I'm scheduling lunches, happy hours, all those things we didn't get to do in person, but really focusing on a level of social connection with my team that was harder to affect during a full remote schedule. So it feels good too to get back into the city on a more regular basis. It also feels really good to see a number of the restaurants, services, reopening and the city really regaining its energy. So here's to that continued momentum as we approach the end of 2021 and go into 2022.
Absolutely. Sorry, go ahead, Max.
Well, I was just wondering, all this, the busyness that you spoke about, Melissa and Onay, does this translate into like a willingness to transact as well? Is that what that means? That there's been a lot of transactions happening?
Yeah, I'm happy to touch base on that a little bit. We've had a pretty intense last year as a business in a good way in terms of really using this time to demonstrate conviction in our markets and to grow our pipeline. Over the last year in our Lend Lease development business, we've acquired about 1.5 million square feet of new ground up development opportunities across 3 markets. We have a large site here in Greenpoint, Brooklyn that we acquired on the waterfront. That's about 850 units of housing that we will ultimately develop there. But I think interestingly enough, when you look at the 1.5 million square feet of projects that we've acquired over the last year, we have multifamily rental. Those projects also include new office, creative office space, as well as a significant new project that we're developing in Boston for life sciences. So I think what we're finding is that this sort of continued activity is not really focused on any one industry, and that there is, we're really evaluating sort of opportunity by opportunity, looking at the sort of micro trends and characteristics that are really driving recovery in those specific markets. So, I look, for instance, at what we've seen, here in New York and in Brooklyn in particular, well, really all across the city. We've seen this incredible residential boom over the last 6 months, both in the for sale condo as well as in multifamily rental. I think what's so interesting about that is that return home for, maybe some people that might have left, and even for new people coming to the city. And, these are at unprecedented levels of leasing and for sale activity, is happening in advance of any mandated requirement by an employer to be at work. So these are people that are moving to the city really by choice, not because their job has told them you have to get back into the office. Because, if you survey employers, you're really finding that is, really not the posture that the large employers are taking. So I think it really bodes well for, thinking about cities and the role of cities moving forward. Cities are still the, sources of, creativity, of energy, of community. And we're seeing this in droves right now. So I think it's a great, very positive trend for New York, and something that I think is going to play really well into the recovery story.
Absolutely. And Melissa, just to touch on your One Java project. So this project was kind of, started during COVID, and now recently plans were filed to build a 14-story mixed use property right at the site. So it's a really interesting project in terms of it's been a COVID, time spell project for Lend Lease. So how is that going today? And when do you anticipate you'll complete the project?
Sure. The project's going really well. We acquired the site in October of 2020. So, really right in the throes of COVID. We had conviction in New York. We had conviction in this location. It's a location that we had been eyeing, for many years. So, COVID really presented an opportunity to demonstrate our access to capital, our, strength of, who we are as an organization, and the ability to really figure out how to underwrite in a pandemic, and how to think about assumptions moving forward. So we closed on that transaction and have been now very busy in all of the pre-development activities. We actually finished the demolition of the site, which is a full city block. So it's a 2.6 acre site, and will ultimately get redeveloped into 850 residential rental apartments. 30% of those units will be affordable. So we will seek to get our footings into the ground prior to the expiration of 421A, which we know is happening in June of 2022. And have, because this project is on the waterfront, it has some really interesting sort of zoning requirements, including the creation of a new public waterfront esplanade. So that's going to be a really significant part of the project, very special part of the sort of placemaking. It's going to open up the waterfront to the community in a way that was never accessible prior to this. We also own the India Street Pier, which is the landing site for the New York City water ferry, and are undertaking a lot of work right now to to strengthen that water ferry location and to make sure that it's fit for purpose. As we know, that water ferry ridership has really been increasing around New York, and that mode of transit is one of the most exciting sort of new modes of mass transit that the city's been investing in, and that has really opened up investment and access to the waterfront.
Absolutely. So go ahead, Max.
No, Onay, I wanted to know about Clarion. So have you guys been also doing some multifamily thoughts, maybe some SFR stuff? What's been going on with you guys?
Yeah, it's been a busy year. As I think for most of us, activity started to pick up in the fourth quarter of 2020. And since that time, we've really seen a rebound of transaction activity of all types, acquisitions, dispositions, as really more sellers and buyers are finding the right midpoint on various property types. We're doing lots of industrial. We have a huge industrial engine, so we're continue to do a lot of both acquisitions and development. We're doing multifamily as well. Actually, within my portfolio specifically, just taking it even more narrower than the firm, which has been incredibly busy. In the next few weeks, we're closing on I have an SFR deal, a built-to-rent deal in Charlotte. I have an Austin office and retail asset that we're closing on. I have a Vegas industrial deal that we're closing on. So we're really seeing the opportunity to transact in multiple property types, multiple markets. We are working on dispositions as well. I have a great Seattle office building, which is getting pretty hot and heavy in terms of the bidding that we're the seller in this case. Can you guys see me?
Mm-hmm.
Yeah. Me? Okay, great. the one thing about remote work, sometimes you have a little glitch and you're not sure how to come back. We have a deal that we're expecting to go into final rounds on, where the seller it's a potential life sciences conversion. So that is another asset class, alternative asset class that continues to see quite robust interests. But even if it remains office, it's going to generate pretty great yields for the eventual buyer. And lastly, on the financing front, we just closed a refi for one of our clients, another Austin office building, and we were able to get pricing within probably 40 basis points more compressed than the deal that was originally financed in 2017. So it's been a busy year, and things are overall, positive, continuing on a positive trajectory.
And imagine a really busy fourth quarter for both of you. Is that correct?
Yes,
that it will be.
That's what I'm hearing, yeah.
It always does.
Right.
I mean, I think it's interesting, Onay, to hear you talk, about the work that you're undertaking right now. And, there is, this exciting sort of theme of recovery that's happening across so many of our markets. I think I would be remiss if I didn't just touch on, a few of the headwinds that, we're really seeing that are creating challenges in, executing on these new opportunities. Are just, as we sort of think about, the economy of cities, what are some of those things that we're seeing? I mean, it may not be a surprise, but we are seeing, supply chain challenges. We're in the business of building new buildings from the ground up. And so these have incredibly complicated supply chains and, require us sourcing all of the, materials that are required to, build a building. So I think it's been interesting to see sort of where those pop up, and almost as quickly as they pop up, sometimes they resolve, others are a little bit more endemic. We're also seeing rise in material costs as well as labor costs due to labor shortages. So I think, there, across all of our businesses, we've, been reading and hearing about, and I think we are, experiencing ourselves just how much, talent is in short supply, and how critical having the right people, whether that's in the field or in the office, is to, to navigating and managing these risks. So I think that those are, real concerns that I just wanted to update and, share with this group. And I think that, the other one that has been, very interesting is sort of the environmental overlay on all of this. We are spending quite a bit of time in this space of thinking about, decarbonization, thinking about resiliency. Many of our development deals are on waterfronts, which pose, really interesting opportunities to think through, some of those opportunities and challenges. And it's a really dynamic moment in the world with, I think, a lot of climate issues coming to the forefront of the conversation, in particular, the way in which our built environment is both a contributor to some of the problems, but can also lead in terms of, thinking about solutions and our path forward to a less carbon intensive future.
Absolutely. I think one thing this pandemic has definitely done is allowed us that kind of pause and reflection to think about our contribution to issues such as that. So hopefully be.
And if I could chime in there, Kathy, because Melissa's 100% right. There's been a lot of stuff that's been great in terms of the recovery, but we're still seeing a few things that are pause for concern. So supply chain shortages are one of them. For us, we've also been able to take advantage of what that means for our industrial pipeline, and we're seeing a huge amount of activity and demand where tenants are coming and absorbing the supply much quicker than they have in many years prior. So kind of at this point, with the ability, landlords having the ability to increase rents at a rate that is faster than the challenges that are caused by some of these material cost increases. So still seeing good profit margins, but certainly something that we think about very actively as we're underwriting these deals. Melissa spent time laying out kind of the ESG as well. So we're certainly thinking about climate. And then the other thing that is at the forefront, remains at the forefront, is the S within ESG. It's now been a year. People are no longer protesting in the streets. So what are we doing as an industry to hold ourselves accountable to the promises that we made last year? So a lot of statements issued. I think where we are as an industry is that we remain in the diagnostic phase, where we're analyzing our baseline metrics and trying to figure out how we set the appropriate targets that are unique to each of our firms and thoughtful and meaningful. So kind of information gathering, disaggregated data gathering, and goal setting. So I'm looking forward to the industry continuing to make strides with respect to social connection, DEI, and its ability to kind of continue to move forward on a broader set of issues as well.
Absolutely. It'll be continuous monitoring and accountability as well, right? So yeah, very good point, Annie. Well, unfortunately, I think we're out of time. I could speak with both of you all day long if I had the opportunity. We only have a few minutes for this red carpet, but I want to thank you both so much for joining Max and myself today. It was such a pleasure chatting with you both.
Thank you so much for having us. We appreciate it.
Bye, guys.
And Melissa, great to see you.
Oh, and bye, Onay. Bye-bye, guys.
Hello, and we are here with two, I would regard legends as in the real estate business, Tommy Craig from Hines and Matt Kelly from JBG Smith. Gentlemen, hello, how are you?
Good, thanks. How are you?
Really good.
Excellent.
And Matt, nice to meet you. I've heard quite a bit about you from Chris Hughes.
Likewise. Thanks, Tommy. Nice to meet you.
So we're starting this conversation at an actually extremely fortuitous time, I think. Tommy, the Google sale, the Google executing the lease on their St. John's terminal thing, right? You know, it strikes me as like, this incredible, blast of optimism for the office market. I was wondering if you could talk a little bit about that.
I think you have to be careful not to read too much into this. Just remember that transaction was consummated a few years ago. That's irreplaceable real estate. And I think in some ways, of course, it's an affirmation of Google's presence in New York and affirmation of the location and the building. I think they're simply continuing. Maybe the most notable thing is that, they have not in any way retreated from the long-term plan they announced to create a second campus, in Hudson Square, which I think speaks to both Google's near-term success and their ability to have a long-term outlook. I think it also reflects the particular strength of the technology sector in New York, particularly, whether it's Google, Apple, Facebook, right? They've all been at the center of some of the most notable transactions post-COVID. And so I'm very encouraged, but I also think this is a little bit about users like that. How much do they want to look at their real estate as an expense or an asset? I think in the case of a location like that, following through to make it an asset that's part of their balance sheet, I think, is something not uncommon, for users of Google's success. No different than JP Morgan in Midtown.
Well, Matt, Tommy, you mentioned like a whole bunch of big tech companies. Now, Matt, you have the other biggest of the big in terms of tech tenants at HQ2 in Washington. Could you talk a little bit about them there now?
Yeah, you can see it right behind me there. That's their first phase of the new Amazon HQ2 under construction. We're about 10 floors up above ground at this point. And you're right, they are, they're the second largest private employer in the US. And one day I would not be surprised to see them become the largest. And to Tommy's point, that real estate you see there behind me is real estate that Amazon will own. And I think it's a real testament to their long-term commitment to these employment centers and to really special places. They are focused far more on talent acquisition, retention, hiring the best people than they are on anything else when it comes to evaluating their real estate decision-making. And so it is all about where they're located. It's all about the neighborhood. It's all about the amenities, the placemaking, and the longevity of the places that they choose to call home and what impact they can have on maintaining and furthering great places, but also first and foremost, making sure that they are in fact locating in places where their hiring will be that much easier in the future by virtue of how great those places are.
And Tommy, another headline for a Commercial Observer regarding Hines was your acquisition of the PG&E office campus in San Francisco. So I'm curious to hear your thoughts. Obviously, San Francisco and New York were both, badly hurt in the crisis for a temporary period. But what's your thought on those markets' recovery today?
So I'll try to be, we're hyper-local is how Hines describes itself. So I won't try to claim an expertise on San Francisco that I lack. But of course, there are similarities. They're gateway locations. They're really about places, as Matt was saying, of human capital. And to build on what Matt was saying is the cost of real estate is a fraction of the cost of payroll. And when you get the human capital right, the value creation in turn is an exponentially higher than the cost of that payroll, particularly with these firms that are engaged in sectors that have a network effect. So I'm actually very hopeful. I think at a fundamental level, commercial real estate will be about a paradigm where quality replaces quantity. I'll keep it that simple. What Matt's doing, what we're trying to do, our Salesforce Tower, the big lease we just signed with Kirkland and Ellis in Chicago, the Microsoft lease that Heinz signed with in Atlanta. You know, again and again, you're seeing the same pattern, that actually in a post-COVID environment where employers have to make the case for returning to the office, quality is what's going to prevail, and probably at the expense of quantity. There'll be a lot of commodity space that ends up having to be repurposed. And if it's residential, it's probably, at least in New York, but I think probably in Washington as well, knowing what I know about our City Center project. You know, what's interesting about COVID is I think even as people were not coming into the office, they were choosing to come into the city for an urban lifestyle, particularly young people.
Right. It definitely makes sense. And Tommy, is it a good time to be a buyer of office product in New York right now?
I don't think we ever generalize. Of course, we would look at the right product. I mean, we're long, right, on two office buildings. So the real question we ask ourselves is it a time to buy or build?
Okay.
And I think we've already provided the answer.
Yeah.
I want to get to something, I want to ask Matt a question on something that you were sort of alluding to, Tommy, just in terms of, you know, so much of this is about, you know, persuading tenants, you know, getting tenants, and so much of the things that tenants are thinking about are quality of life, quality of air, quality of, you know, just the environment around them. Was that a little bit of, in your thinking in terms of the decarbonization effort that JBG Smith has been doing?
Yeah, it was, Max. Absolutely. The decision that we made was fundamentally rooted in the expectation and the belief that fast forward, I don't know if it's 2 years, 5 years, 10 years, however long it takes, this will be the norm. Every employer, every company, every occupier will have to become carbon neutral. There's really no way around the continued warming of the planet unless we do that. And so we certainly pride ourselves on being leaders in a lot of different areas, but this was an area in particular where we saw an opportunity to do something on the earlier side, do something before many others have done it. We are not the first, but we are among the early adopters of this. And we believe it provides us with a competitive advantage in tenant retention and customer attraction, in particular on the multifamily side, but also increasingly on the commercial side. And we see it as a real competitive advantage that when you fast forward to the day when everybody does it, it won't be a differentiator. But today we think it is, and we know it is because we see it every day in conversations with prospective tenants. And it comes back to what I was saying earlier. Tenants want to occupy a home that is appealing to the people they want to hire. And increasingly, the talent that wants to work at these big companies are asking questions in job interviews. Is the company carbon neutral? Is the space where the office is located carbon neutral? What are you doing with respect to that question? And we're helping those customers of ours provide an answer to their most important asset, which is their talent.
I wanted to, we do have to wrap up in a minute, but I did want to ask both of you, I mean, we've talked a lot about office. Where are you guys focused beyond office? I have my own ideas, but Tommy, if you could just lead us off.
When you say where, like what geography or what type?
No, I meant like, retail or multifamily or.
Which sector? Yeah, where is office in terms of sector choice? In a funny way, office is a contrarian bet, but I think it's going to have scarcity value. There'll be a limited number of post-COVID buildings. and Matt, I have no doubt JBG will be at the leading edge of those in Washington and the other markets it covers. We're out, at South Station, our 2 buildings in New York. I really do think that there's a chance to do buildings post-COVID that are fundamentally different. I think I've described to you at 555, it's, a building that combines geothermal with a thermally activated slab, radiant heating and cooling, a notion about energy management that's circular with no waste energy. But most importantly, it involves, we've eliminated, return air that's recycled into office space. I think people care about that stuff. So I think office is a contrarian bet. But I think in our part of the world, there's a little bit of a rebalancing, between New York City and the surrounding suburbs. And I think we see in the right location, we're doing multifamily, for sale condo, industrial, and office. I think that the right experiential retail will be important, if nothing else, to support the office experience as an amenity. But I think actually when you combine all the uses, in the right way, you can really create place. And Hines is doing that around the world right now.
Matt, do you want to have the last word on what you guys are up to?
Happy to. We are on our way to becoming a majority multifamily company through development of new multifamily in and around Amazon's new headquarters in National Landing. We have always been very focused on place-driven experiential retail as an amenity to other uses. That's really the only kind of retail we like to own, is where we can really create a place with it. And in the next couple of years, as we divest non-core office assets, what we will end up owning and concentrating on will be office buildings within about a half mile of Amazon's new headquarters, including a lot of Amazon leased space, and multifamily in and around that submarket and other select growth nodes in the Washington metro area, with the majority of our portfolio being multifamily.
Well, very exciting stuff. I can't believe that our time is up, but our time is up. Matt Kelly, Tommy Craig, thank you so much for being with us today.
Thanks for having us.
Kathy. Thank you, Max. Thank you,
Take
Matt.
care.
Okay. Have a good day. Bye-bye.
Thank you, Max and Kathy, and all of our honorees who joined us on the red carpet this afternoon. I'm Michael Rose, CEO of Observer Media. It's my pleasure to welcome all of you to the 14th Annual Commercial Observer Power Gala. Each year, the Commercial Observer Power Gala recognizes the industry's most influential players, those conducting the biggest deals, those introducing the most innovative developments, technologies, business models, new designs, and those who are consistently setting a new standard for excellence and leadership. 18 months ago, the commercial real estate industry was tasked with thinking strategically and differently about how we connect in a world flipped upside down overnight. Smart, innovative, and often counterintuitive decisions were needed, and they were needed quickly. Industrial and logistics experts responded by preventing crucial deliveries from coming to a halt. The life sciences sector is working overtime to provide much needed laboratory and research spaces. The hospitality and retail industries had significant challenges that had an instant impact to their business. They are now welcoming us back with new, forward-thinking, safe, and experiential spaces. The office sector has adapted and is putting tenant health, wellness, and safety at the forefront of property offerings. New and existing tech companies have played a critical role in supporting these sectors each step of the way. Real estate has had a critical role to play in moving the country forward, largely due in part to the efforts of our 2021 Power 100, Power Finance, Power DC, and Power LA honorees. We at Observer Media and Commercial Observer would like to toast the hard work, put forth by this year's Power Honorees and industry leaders. We'd like to now kick off the program by looking back at some of the highlights of your achievements, your thought leadership, and key headlines from the past year. Cheers.
When we packed up our offices on March 17th, 2020, nobody could have guessed it would be here, 20 months later, still navigating a crisis that was so unexpected and fast-moving, it knocked us clean off our feet. But with a time of crisis comes a need for strength, a need for courage, a need for leadership, a need for resilience, and a need for unity. And those stories are written across the pages of Commercial Observer every single week. Our 2021 Power Lists honour those who felt the fear and moved forward anyway. Those who, when the time was right, picked themselves up, dusted themselves off, and got back down to business.
Making vaccinations broadly available and testing centers broadly available. I think government stepped up. And as Kathleen said, the landlords have also stepped up. I mean, we had a health security plan not dissimilar to what Kathleen described in place in June of 2020. And so we were ready, for everybody to return.
Over the past year, the fruits of that labour and commitment have been clear to see in many of our headlines. Activity has returned to the market, and so has competition. Big deals are closing every single day, including transactions that involve asset classes marred by the pandemic, such as retail, hospitality, or the other one with a big question mark over it, office. The investment sales market is back, with buyers clearly not being shy when it comes to putting down some serious dollars. Big leases are being signed. The war for talent is heating up.
People's policies need to obviously take into account the desires of the workers, while at the same time, take into account the needs of the business. But one thing that I do think is much, much harder to effectuate in a remote environment is innovation and collaboration and teamwork.
It's not just about making sure that we can engage diverse talent, source diverse talent, find them as early as possible. It's also about creating industries and businesses where diverse talent wants to be.
City streets are once again full of their residents, who've embraced their old homes as new loves and as tightly as ever. The turmoil, the devastation, and the disruption also brought time for pause and reflection. And we hope that we as an industry are now emerging better, stronger, and more equitable than ever before.
Loss of population, that seems to me a really big problem for the city. What are some of the ways to reverse that? Can you both talk a little bit about that?
Yeah, first of all, just to add to the last question, I do agree with Elliot. I think this election especially is pivoting around three topics, clearly, which is safety, growth, and affordability and equality.
What this pandemic has done, it's highlighted so many questions about, making cities resilient and equitable and inclusive.
The pandemic has brought new appreciation for many personal things: family time, flexible work schedules, fresh air, Netflix, hugs, and some asset classes that we now fully appreciate on both a personal and professional level. For example, the life sciences sector, which we thank for Pfizer, Moderna, Johnson & Johnson, as well as a myriad of other vaccines and remedies in our past, present, and future. The war against COVID isn't over, but we're in it together.
And you walk the streets of New York, and you see the energy, the diversity, the character. It adds another bounce to your step.
It is a solemn anniversary, and even 20 years later, I think it's very appropriate that we not forget the tremendous loss that we suffered on that day and the courage with which New Yorkers and Americans responded.
Hey, we need to fight for this city. We're just not gonna let this happen. We need to fight for this city to make sure that we come back better and stronger and more equitable.
Z.B. White once said, hang on to your hat, hang on to your hope, and wind your clock. For tomorrow is another day.
Last year, nobody was much in the party spirit, forgetting if we could have even hosted our annual celebration of the names on the Power 100 and Power Finance for safety issues. It was a bleak moment. We had no vaccines. We weren't sure when or if we were going to get one. And one couldn't say whether things were going to get better or worse. A Power Gala seemed more than a little tone deaf. A year later, we're constantly reminded of how hard the work is of getting back on our feet. We got our vaccine, but it turned out that wasn't so simple. There were things that we didn't think of and things that we couldn't know about. But tonight, I feel much more hopeful than I did 12 months ago. Last night, Commercial Observer hosted its first in-person event since March of 2020, and I was extremely pleased we were able to do so. It said, I think, that it's not enough to survive the worst of the virus. It's not enough to figure out how to schedule our lives on Zoom calls with minimum adequacy. It's important to get up and reach for what we had once had, to not let it slip away, to put in the effort, to put in the face time. And it also was important to recognize the effort. We need to say to those who have risen to the top of this field, we see you. We know what you've been doing. We salute the perspiration and the fortitude. 2020 was not a great year. 2021 is less than we had hoped for, but better than we had feared. One thing I think everyone at last night's in-person gala and most of the people attending this virtual gala has in common is that they face reality when it's less than we had hoped. Recovery is hard work. It feels like a long time. It has been a long time. But we will all be there to greet the dawn. And before we welcome our opening keynote speakers, I'd like to take a minute to thank this year's Power Gala sponsors, our gracious host sponsor of the opening honoree reception last night, Silverstein Properties, and tonight's program sponsors, Accenture, Ackman Ziff, Acor Capital, Burden LLP, CIT, Columbia Property Trust, Cushman & Wakefield, Eastal Secured, Himmel & Marengoff, Hines, JLL, JP Morgan Chase, Kensington Vanguard, Latch, Mac Real Estate Credit Strategies, Marks Realty, Related, RXR, Savills, Signature Bank, and Starwood Property Trust. Thank you again. Now I would like to introduce my colleague, Kathy Cunningham, back to the screen for our opening keynote with Larry Silverstein, Chairman of Silverstein, and Mary Ann Tai, CEO, New York Tri-State Region, CBRE.
Hi, everybody, and thank you so much for joining us for Commercial Observer's Virtual Power Gala. My name is Kathy Cunningham. I'm the finance editor for Commercial Observer, and it's my sincere pleasure today to be joined by two of my favorite people in real estate, Larry Silverstein, Chairman of Silverstein Properties, and Mary Ann Tai, the CEO of CBRE's Tri-State Region. Hi, Mary Ann. Hi, Larry. How are you? Great to see you both today. Now, as much as we're honouring the honorees of our Power List today, we're also commemorating the 20th anniversary of the 9/11 attacks. And today you're both actually sitting in 7 World Trade Center, which was the last tower to collapse that day and the first to be rebuilt. And I recently interviewed you, and I find you both fascinating because your stories are so intertwined when it comes to the rebuilding of the World Trade Center and downtown as we know it today. So first of all, just to start off, so when you look around you today, how do you feel about the rebuilding and what's been accomplished at the World Trade Center site? Larry, do you want to begin?
How do I feel about it? Well, I look at it on a daily basis, and I feel very gratified because it's come a very long way. We've gotten most of it done, not all of it, but most of it done. And I have to tell you, Mary Ann has done a fantastic job in getting this place rented for us.
Yeah.
Nobody better at what she does.
Make sure you have this.
Right
We're
here.
going to run this ad on a loop for in my career. And actually, I think I won Deal of the Year for one of them, for the Empire Blue Cross Blue Shield deal, and then also the Marshall McLennan deal. So I had a real grasp of the trade center. And on that day on 9/11, in terms of all the levels in which that tragedy impacted me, it was also, I left my apartment and went to the offices of Marsh because I knew where the plane had hit, and indeed they lost people that day. I have to say, we have been on a long journey of over 16 years in terms of the recovery. From that, we've had the enormous blessing of the vision that Larry brought to it, and also the steadiness of his commitment to it. But it's as though every tower we do learns from the tower that came before. And the entire landscape, I think, has really ended up being just an exceptional environment, and we're getting close to finishing. I have to say, in the beginning, my single biggest surprise was the brokerage community's failure to grasp the trade center. That indeed, I remember 10 years into the leasing, a broker in my own firm whom I like and respect.
Right.
I asked him about bringing a tenant down to, I think at this point we're leasing Tower 4. And he said, I haven't been downtown in 10 years and I have no intention of going downtown. And that always was hard for me to deal with, because I think of our profession, brokerage, as being one that champions our city, our nation. And I felt that just patriotism alone should have caused people to focus. The good news, though, is we've gone beyond.
Right.
We are now, we are selling an environment that doesn't take any imagination. It's here to be seen. And there is a deep appreciation of what a remarkable thing these buildings are and this place itself is.
Beautifully stated, right? I support everything she just said.
Another ad. Now, Larry, in terms of why was Mary Ann the right woman for the job in terms of re-tenanting the World Trade Center? Was she the only person you had in mind that could possibly accomplish what you wanted to accomplish? Or what was your thought behind that?
Please let me tell you something.
Go ahead.
I have been a team member of, Larry hired a team day one. The team has morphed over time because sometimes fatigue sets in. But we're a full-blown team, and it isn't Mary Ann, just to be clear.
It's Mary Ann and a team of very dedicated people.
Right.
Terrific. Absolutely terrific. And I bless them for what they've done, for their commitment to it, their constancy at it, the dedication to it. It's been wonderful working with Mary Ann and her team all the way. And so, yeah, 16 years. It's a long time.
Hasn't fired us yet.
Well, there's more work to do. Can't fire you yet. There's more work to do, right? So
Mary Ann and her team are part of everything we've accomplished down here. And that's the way it is. And we're proud to be able to say it and to look back with joy and happiness and deep appreciation.
But can I also tell you, it's that kind of leadership. And what Larry has been a leader to us in the leasing side, he's been with the architects. He's been with his in-house staff. He's been with every person who works on this project. So when you have a leader like that, and you have somebody whose commitment is so alive and so consistent,
but you know,
you're following the lead.
When you're doing something like this, when you have this kind of responsibility,
right,
you really have an obligation that it produces to be with it all the way. And so I think a long time ago, I learned that if you've got something you want to accomplish and that's worth accomplishing and giving your heart and soul to, you do it with full commitment, absolute passion, and no other way, nothing less. And so this became the most important part of my life 20 some odd years ago. And I just said to myself then, and I said to my sweetheart, Clara, we've only been married now. We've known each other, we're together for 70 years, married for 65 years. And of all my wives, she's by far and away the best. But I remember sitting with her very shortly after 9/11, sitting together and just discussing what was ahead of us. And that I said, I can't make this decision alone. We have to make it together because I'm going to need you by my side every step of the way. So tell me what you'd like to do. You want to build a yacht? You want to travel around the world? Because I promised you, once we had the Twin Towers, we had the brass ring, we do whatever you want because we had the capacity to do that. Alternatively, I said, if you want to rebuild the Trade Center, we could do that too, but I need you right by my side.
Mm-hmm.
She looked at me and she said, you know, you're not going to be happy doing anything else for your life. So why don't we get on with rebuilding the Trade Center? And I looked at her and I said, what a hell of a partner you are.
Oh, definitely. But
by my side every step of the way. And without her being there, I couldn't have accomplished what I accomplished. So there are two great women in my life. A, my wife, and B, Marianne.
your work wife, right? Sorry, go ahead, Marianne.
I was just thinking about the first person he recruited was Clara.
Yeah.
I mean, after that, you built each, just as you were building each building, you built the team as well. And it's, again, we all know each other. We all take pride in what's been built.
It's been a hell of a journey.
Yes.
It really has been. And to be able to work together as a team has been a blessing.
And
it's also a privilege. And so I've been fortunate enough to have it.
Oh, 100%. I completely understand that. Now, Larry, where did that fortitude and commitment come from so early on? You know, I think you're so highly respected and revered today in terms of what you've accomplished with the rebuilding, but you had that initial strength and fortitude in terms of we're going to rebuild, we are going to recover from this, really quite immediately after the attack. So where does that strength come from? Is that something that you've always had, or how would you describe that strength, you know, the source of that strength, I guess?
I think I've always had the realization that whatever it is you do in your life, you do with full heart and soul, full commitment. And it's been a part of me. And so I think back to when, I think 2 or 3 days, I think it was Wednesday or Thursday. It was Thursday morning, about 7 o'clock in the morning on the 14th. I got a call from Governor Mccarthy at home who said, Larry, he said, can we talk for a few minutes? I said, of course. And he said, what do you think we ought to do? And I said to him then that there's little doubt in my mind we needed to get on with the rebuilding and we needed to do it as quickly as possible. Because I said, if we don't do it, the terrorists will have won. They will have accomplished what they wanted to accomplish. Because this wasn't just an attack on the Twin Towers, this was an attack on America and everything we stand for in this country. And we can't let that happen. We can't let that sit. We've got to do something about that. And the only way we're going to accomplish it is by rebuilding. So in my view, let's get on with it as quickly as possible.
Right. Yeah. Amazing. Now, in terms of the re-tenanting again, Marianne, so with the new World Trade Center came, not only the new towers, but also a really just, reimagined, completely different, what used to be financial district, but now is no longer a financial district. So I remember you telling me about the type of tenants that came in that were sometimes a big surprise for you, such as Spotify and what have you. So it's such an interesting story, I think, just the kind of the changes we've seen in Lower Manhattan, the World Trade Center towers in terms of the completely new brand of tenants, right?
Yes, I think that there are so many surprises that have come from this endeavor. And I think one of them is when you design a building, you design it envisioning who is going to be occupying that building.
Right.
And at the dawn of this project, it seemed obvious that it would be financial service firms.
That was the assumption.
Right?
Yeah, absolutely.
And that what we had going for us is that we had big floor plates and could make great trading floors.
That's correct.
And so when you gave the mandate to the architects, that was the whole idea. And then lo and behold,
big square footage. So 65, 70,000 square foot, 75,000 square foot floors were at the base of the major buildings, the base of Tower 3 and Tower 2, right? And so
and 3 too, 3, 4, and 7. But 7 a little bit smaller, and 2,
yeah.
Exactly.
So 7 was a straight shaft tower, not the others. And so the fact that funny, we looked at the large floors that went into Tower 3, and after a while, as the building was going up, I began to scratch my head, and I said to Marianne, Marianne, I don't know who was gonna take those large floors, because the demand for big trading floors for finance today doesn't seem to be as heavy, as real as it used to be, until she brought Rubem to the site. They looked at those floors. They said, "How many do you have?" And I said, "We got 5 of them." They said, "We'll take them all."
Yes, they did.
Absolutely staggering. I couldn't.
And
heaven.
And they love it.
And they were terrific. Right?
Speaking of loving, so the other night, someone forwarded to me an Instagram post from a 24-year-old engineer who works at Spotify. And
Really?
It's a shot of his, I guess he's sitting at his desk looking at the area he's in, and he wrote on it, "Yeah, no, don't want to work from home." And it was
good for him.
It was just this, and when you saw how he's looking out the window, it's so beautiful. A lot of what has been involved with the tech firms is that the caliber of the buildings, the overall environment, everything from, by the way, the air quality through
everything,
the support for the technology, on and on, all of those things set in this beautiful setting where you can actually experience where we're on an island. You can look out and see the Statue of Liberty, et cetera. You can watch the day, the sky change as the day goes forward. This is an attraction to people. You don't have to induce them to come to work because, as he said, yeah, no. I love the way he wrote that.
That's the sentiment we like to hear.
Exactly.
And encourage.
It's great. I feel like Mary and I were speaking beforehand about how activity is really returning now to New York in terms of deals closing, new construction starts and what have you. There's a lot of activity, a lot of buzz. So it's great to hear that people want to be back in their offices. They know where they feel happy. They know where they can do their best work, and they're excited about getting back to it. Right? It's a great thing for New York to getting back on track.
It's wonderful. It's absolutely joyous.
And I think the first deal we're going to do since the close down is going to be a growth of an existing tenant. One of the miracles of this campus that we have is how many tenants we've had who started in small space and kept moving up to bigger and bigger space.
Kept growing.
Yes. So whatever energy the space possesses, it's clearly good energy because
it's worked very well.
It's worked well for these companies.
That's incredible. And I feel like the whole World Trade Center today, all the towers have this energy around them, right? In terms of, we report on it every week, the different tenants are taking space there, and even walking through the site now is just a buzz of energy, which is also a great thing to see.
Something that has also become a reality. This neighborhood has changed completely. When the
100%.
When the Twin Towers were up, you could roll a bowling ball down any of the major streets, down Walls, any of the streets, after hours, Deadsville. I mean, there was just nothing happening here. Today, you've got maybe 60,000 new residents in this area. Never lived here before. As a matter of fact, in the country, this area in Lower Manhattan has the highest walk to work, the highest work-live relationship of any neighborhood in the United States. So I think 27 or 28% of the people who live here work here, which is the highest in the country.
And such a luxury. Witness Mr. Silverstein who walks to work.
So
right.
It became obvious to us. We bought a piece of land, not at the Trade Center. I remember Clara saying to me one day, she said, you have such a concentration in the Trade Center. Shouldn't you concentrate on maybe acquiring outside of the Trade Center? I said, sweetheart, it's a very good idea. So I think maybe a few months later, I said, we're now possessor of a property outside the Trade Center. She said, what'd you buy? I said, we bought the old movie site.
Yeah.
Needed it anymore because they came into our building. I said, I bought that. She said, what are you going to do with it? I said, well, I don't know. I said, maybe we'll build a hotel here. And maybe we'll put some luxury condos at the top of the hotel so we have a place to live. So that's exactly what we did.
Surprise will move there.
Diversification.
I also want to point out, though, you also put in your dream swimming pool in the building, too.
So I do 20 laps in a 75-foot pool every morning.
I didn't know that, Larry. Wow. Okay. Good for you.
I love it. It's every day without fail. It's just great exercise.
Oh, swimming's so good for you. I love to swim too. Swimming's so good for you. So that's fantastic. Got everything right there. Now I think we're wrapping up soon, but I'd love to know, what do you think's next in the Larry and Marianne story? What's the next chapter for you?
Yes, sir.
There's another chapter about to be written, right?
Great.
And that is, well, first we're going to build Tower 5, which was originally supposed to be an office building. It's now going to be a residential tower. So we're going to build 1,300 units of rental housing right here on the World Trade Center campus to house all the people who work here, number one. Number two, but maybe equally, maybe more importantly, Tower 2 is the last office site that's available to be built at the Trade Center. We made the decision to go forward to build Tower 2, to find a user, get the financing, and do it. And so I want to do this while I'm here to enjoy it. I'm 90 years of age now, so I don't have a hell of a lot of time which to accomplish it. So the idea is to find a user right away, because I think we've got the financing. And so move this thing forward. So I said, Marianne, this is our next obligation. Let's get it done, but let's do it quickly while I can enjoy it.
Let's get.
That's the issue.
And we're committed. We are.
So it's only going to be only $4.7 billion and only 3 million feet of space.
Make no small plans. They don't have any power to inspire you, right?
There's no such thing in there. Yeah. And I heard for your 90th birthday, you received a cake in the shape of the World Trade Center too. Is that right, Larry?
That's right.
Absolutely.
That's what we did. We made the cake that way.
Made the cake, right?
Just
So
we could internalize this plan.
I said, I have to break it to this. How do I do that? But I did. It was delicious, let me tell you. So we all enjoyed it. All had fun with it.
Excellent. Well, I can't wait to see what happens next. Obviously, we're going to be covering it, with Commercial Observer, but it's also such a thrill to chat with you both, Larry and Marianne. Thank you so much for your time today. And hopefully I'll see you in person at some point soon.
Thank you, Kathy. It's always a pleasure.
Just be well.
Thank you so much.
Stay well.
You too. Take care and hopefully I'll speak soon.
Thank you.
Thank you so much.
Hi, I'm Peter Weiss, Chief Real Estate Officer at Latch. Latch is a technology company that focuses on making spaces better places to live, work, and visit. We do this through Latch OS, an integrated hardware and software experience that helps streamline building operations, enhance the resident experience, and enable more efficient interactions with service providers. I'm thrilled to be joined by George Perez. George is not only a titan of the real estate industry, he's also the epitome of this year's theme, resilience. Over the past 40 years, George has helped Related Group identify and capitalize on emerging trends by thinking differently, innovating, and challenging the status quo. He also happens to be a Latch customer. George, thanks so much for joining me today, and congratulations on being recognized as a Power Honoree.
Thank you very much, Peter. Nice being here with you.
Great. So I want to start us off with something light. Knowing you're a big art collector, what's your view on NFT? Were you hitting the bid button at the Beeple auction?
I'm an old timer, Peter. You know, I've talked about this a lot. It's not for me. I don't even understand it. I like to touch my art. I like to see it in the walls. I like to see it in museums. But to each his own, right? I mean, I think a lot of people are making a lot of money. Remember, art for me is not a business. It's a collection that is going to be left to a museum. So when people tell me how they've been trading this almost like if it was baseball cards, is something that it's hard for me to understand.
Totally understand. So now that we know your position on the digital space, let's jump more into the physical. How have you seen the demand for multifamily housing evolve in response to the pandemic, aside from the New York real estate community relocating to your backyard?
Well, you know, that's a big aside, right? Because I mean, I think I get the feeling that all of New York is coming down to South Florida, not only Miami, but everywhere between Palm Beach, West Palm Beach, Fort Lauderdale, and Miami. We're getting incredible demand from the Northeast. And it's not only from New York, we're seeing it come from Boston, from Philadelphia. Chicago has become a very big source for us, not only of people buying and moving into condominiums and apartment rentals, but also people looking for AAA office space in the technology and financial services sectors. So we've seen a huge uptick in demand. We actually have none of our existing condominiums have any units for sale, and the ones that we have started selling are selling very, very briskly at prices that are very high. We're not seeing any slowdown here, and it's not only coming from the Northeast, but for the first time we're seeing a pretty substantial movement from the West Coast, from both LA and San Francisco. Coming to Miami. And this is everything, like I said, from financial companies to technology companies. And I don't see that slowing down. We're very, very happy. COVID has definitely accelerated this. People want to be where they can be in open spaces and not cities that are too tight and constrained. Year round, you can be outside here in Florida. Every New York restaurant has come down to Miami and or Palm Beach. So it's really been a blessing for us. Of course, COVID has been a disaster. It's been a lost year, but it really has accelerated the move of people to South Florida.
So COVID notwithstanding, what are the top technology trends that you've seen in the multifamily space over the last 5 years or so?
Well, you know that more than I do, right? I mean, your company is making life easier, and those are the trends that we're seeing. Before it was how big is your community room and what amenities, physical amenities you have. All those things are very important, but I think what's most important right now is what's your ease of living. Does that apartment, from that apartment, is it an intelligent apartment or condominium? Can I order my groceries? From my office, can I look at inside my refrigerator and link with the grocery store so they can provide me whatever I am missing? You know, can I look at my security cameras? Can I do, you know, reservations? Can I do multiple things that now only technology can provide to make everything a lot easier. So I think technology has, as the way we're using it, has eased the way that people can access everything. And that's what we're trying to do. We're trying to make life easy. The other thing that is very important because of COVID is that people are much more health oriented. What about this pandemic, and what about, are there any Delta variants or different Delta variants? Is there going to be another one? So open space and open spaces have become very important, and we're trying to provide as much of that as we can in our developments, so people feel healthier environment. Finally, there is a big move to working either full-time or part-time in your home. So we're providing larger apartments with offices, and in those that are smaller apartments, we're providing workstations, workplaces, conference rooms. It's almost like a WeWork within our developments, so people don't have to go outside their building to work.
No, that's great. So other than those open spaces, what should multifamily and condo owners do, or developers, to better prioritize tenants' health and safety?
Well, we have green buildings, that's very important, and open spaces. So we try as much as possible to make our spaces, particularly in Florida that have all year-round weather, to have large gardens, outside pools, even the community rooms that are air conditioned. When it's not hot, they can be fully open, and we're looking for cross ventilation. So we're doing everything that has a medical and health orientation to the programs. We're doing, all our air conditioners are providing very much processed clean air. So again, everything that has to do with what is going to be a healthier environment, how can I go outside, and how can I do almost everything that I need from my building without being constrained. You don't want to go through an epidemic, or you don't want to go through a big issue staying in a tiny small apartment and staying inside.
Sure. So sustainability efforts should be top of mind for developers these days, for sure.
Absolutely.
Awesome. So generally, how has technology shaped related group strategy? I know we spoke in specifics, but how do you look at technology across the entire organization?
Well, it speeded up, the technological process for us, and everything from the way we rent apartments, the way we sell apartments, the way we do renewals for apartments, the way we can communicate with the tenants, when they're moving in their apartments. So now the communications have become much faster, much easier, much better. So we can satisfy the needs of, the residents, basically from concierges or maintenance people that are in a computer and know exactly what is going on in your building. You can access your apartment, more easily. So technology, and we were working on these things before COVID came, but it made us, much more conscious about all the changes. We've actually even gone to South Korea to look at the latest technological improvements there, for what is the new smart home. So we have invested a lot. The people, even within the organization, the way we communicate with people, although we always want to see people live, but right now I am talking to my executives through Zoom, and just like I'm talking to you, almost on a constant basis. So the need for human interaction is a social need, but not so much now a business need. I can do a lot more business-wise with my employees and with my tenants that I did before. And it's amazing how people thought, that, for example, you wouldn't buy an apartment, you wouldn't rent an apartment by just looking at it, but the systems have become so incredible, the life that you can project, through going through an apartment, that we're getting a lot of sales, for example, and a lot of rentals by just purely people that are coming into the internet. So we've had to build a lot better programs to make them see what their possible apartment is going to be. And this is not only with real estate, but for example, art. I never thought that people were going to buy $1 million pieces of art through the internet, and it's happening. The changes have been substantial in the way technology is being applied to reach potential customers.
George, thank you so much. We applaud your progressiveness in technology, and congratulations again on your honoree.
Thank you very much for having me, and it's great being with you. Take care.
Thanks, George. Take care.
All right, good afternoon. I'm Taya Kruger, the Senior Principal at Burden LLP, and it's my honor to present tonight's Economic Recovery Award. The Economic Recovery Award recognizes a team that took a proactive, bold, and decisive leadership role throughout the pandemic to safely kickstart greater economic activity by supporting struggling businesses, serving on advisory councils, and working to safely return employees and tenants back to their offices. There's no shortage of ways in which this year's award honoree sought to achieve this. To support return to work efforts, they held regular town hall meetings with their commercial tenants to walk them through their plans to welcome them back to their buildings. And last year, they released a suite of new technology services to assist their tenants' plan to return. Recognizing that health and wellness are vital to worker productivity and satisfaction, they brought back in-person and online fitness and meditation classes, lectures, events, and meetups, and continue to offer virtual and on-demand content to their customers. They completed several significant deals in New York and beyond that were instrumental in spurring economic activity and growth. It's truly an honor to announce that the 2021 Economic Recovery Award honoree is Silverstein Properties. Please welcome Dino Fuscio to accept this award on behalf of the Silverstein team.
On behalf of Silverstein Properties, I'm really honored to accept the Commercial Observer's Economic Recovery Award. I joined the firm as Chief Operating Officer on March 16th, 2020, the exact day that New York City shut down in a state of emergency. During the pandemic, we made it a priority to support our beloved downtown neighborhood. We partnered with the Downtown Alliance to create a rental assistance grant program to help local businesses provide vital services to residents and essential workers in the area. And we contributed to a number of campaigns to educate local business owners about available funding opportunities and encourage residents to visit the shops and restaurants that were still open for business. We helped launch Project Parachute, an initiative between property owners and housing advocates to keep vulnerable New Yorkers impacted by COVID in their homes. We raised over $4 million to assist residents with limited or no access to government resources, including undocumented immigrants. The project supported those communities that were hit disproportionately hard by the COVID pandemic, including the Black and Latinx communities. Although March 16th of 2020 was definitely a challenging time to start a new job, I'm so impressed with how everyone at Silverstein Properties worked together under difficult and remote conditions. Tragedies like 9/11, Superstorm Sandy, and the pandemic bring out the best in New York and New Yorkers. We are honored to do whatever we can to help our customers and our neighbors bounce back.
Hello, everyone. I'm Amelie Brewer with the Commercial Real Estate Asset Services Group at Accenture. It is my pleasure to join you tonight to announce the Green Future Award. I'm especially excited to present this award as our team at Accenture believes now is the time for collaboration, for business to partner with government and society to reimagine, rebuild, and transform our global economy into one that benefits all stakeholders. We are helping organizations embed sustainability into every area of their businesses so they can create new sources of value and deliver on those values. Tonight's award winner is being recognized for taking a rigorous approach to improving our collective future and urban living standards by accelerating sustainable practices. The 2021 Green Future Award goes to one of the preeminent leaders in commercial real estate sustainability, Empire State Realty Trust. With its groundbreaking deep energy retrofit at the Empire State Building and aggressive carbon neutrality goals across its more than 10.1 million square foot portfolio, Empire State Realty Trust is an industry leader in energy efficiency with a well-established emphasis on healthy work environments for tenants and employees through investment in superior indoor environmental quality throughout its spaces. ESRT has been long at the forefront in the real estate industry's sustainability efforts, most notably for the innovative energy efficiency retrofit at the Empire State Building in partnership with the Clinton Climate Initiative, Rocky Mountain Institute, and JLL. The team at Empire State Realty Trust has an expansive list of breakthrough accomplishments in the energy savings and sustainability spaces. It is my pleasure to introduce and welcome Anthony Malcolm, Chairman and CEO, and Dana Schneider, Senior Vice President and Director of Energy and Sustainability at Empire State Realty Trust, to accept the award on behalf of their team.
Hi, I'm Dana Rodman Schneider, Senior Vice President and Director of Energy, Sustainability, and ESG at Empire State Realty Trust.
And I'm Tony Malkin, Chairman, President, and CEO at ESRT. On behalf of all of our colleagues at ESRT, Dana and I are honored to accept the Green Future Award at Commercial Observer's 2021 Power Awards and to be nominated by our partner, Code Green.
ESRT is proud to stand at the forefront of the real estate industry's sustainability and indoor environmental quality efforts. Our innovative deep energy retrofit at the Empire State Building has provided leadership for the world, and we would like to recognize our partners, the Clinton Climate Initiative, the Rocky Mountain Institute, and JLL for their partnership in the process.
Our replicable processes within the Empire State Building have cut carbon emissions by more than 50%, and we are on track to meet our goal of carbon neutrality in the building by 2030 and throughout our portfolio by 2035, with a focus on on-site actions to achieve that result.
We partner with our tenants to help them set and achieve their own sustainability goals through energy and water conservation, responsible materials specifications, and waste diversion. Our energy reduction goals cannot be met without tenant collaboration and participation.
Modernized for the 21st century and equipped with industry-leading indoor environmental quality, our spaces, which include pre-built, full-floor, and multi-floor spaces, are priced at a level to make healthy buildings accessible and to bring tenants back to the office with confidence.
We will continue to partner with legislators and other real estate leaders to transform our built environment and to transparently share our work so that others in our industry can do the same.
So thank you, Commercial Observer, for the great honor. We appreciate the recognition for the hard work of the ESRT team.
Welcome to our guests, Ken Kaplan and Kathleen McCarthy of Blackstone. They were numero uno on Power 100 this year. They were the big cheese, the head honchos. So we're extremely honored and delighted that they joined us today. Ken, Kathleen, welcome.
Thank you.
Thanks, Max.
We are very honored to be named at the top of your list. So thank you, Max, for that very nice introduction as well.
Well, we really, we talked about it a lot, and we spend a lot of time discussing, this list. And, there was no alternative, really. I mean, Blackstone and what you guys did this year was it was something to behold if you're interested in real estate. And I do want to just I guess start along those lines. You guys really did, I felt, take interesting new steps, especially at a time of such uncertainty and so many people hesitant and pulling back. Can you take us into your thinking about, like, some of the steps that you guys took over the last year?
Sure, well, I'll start. So again, thanks, Max, for having this moment together and really for honoring us with the position on the list. And I would say one thing to keep in mind always about our business is that we've been at this for over 30 years now. And so we've lived through a lot of different kinds of environments. A crisis like the world has experienced in the last 18 months is certainly new for all of us. But we've definitely been through good times, but also really tough times. And I think there's a couple of hallmarks of how we operate that really help us in these moments. One is by just staying calm and staying focused on the information in front of us. And we have just huge benefit from the breadth of our portfolio and the information it can give us every day on what's really happening on the ground. And we certainly used every bit of that information to help us navigate any of the investment and asset management decisions we had over the last year. I think the other thing that we'll always operate with is just our high conviction approach to investing and trying to stay really focused on the places where we think the world and the way it is utilizing space, whether it's through more travel or less, or through greater use of e-commerce, or more content creation because people are just demanding more of that on every device they have. These are the kinds of things that, came before the pandemic, and we think will come out strongly on the other side. And so we really followed those convictions as we have sought to invest capital in this environment.
Mm-hmm. What about some of the specific places that you guys were, looking? I mean, obviously, you guys did so much in housing. You did so much in logistics. Why don't we just discuss a little bit about logistics? Why it's such an attractive category at the moment?
Sure. I'll pick up where Kathleen left off, and logistics is a great place to start because it does represent our largest exposure. It's nearly 40% of our global portfolio today is in logistics. And it's also a great example of our approach to investing, as Kathleen said. We're high conviction, highly thematic investors. And the story of how we got to the scale of portfolio in logistics is a good example of that. So we started investing in this incarnation in logistics back in 2010, post the GFC. And it really started with an investment that we just saw a really good value opportunity. And the way that our business is connected, the way that we look at the data coming off our portfolio, we quickly saw from that initial investment, outperformance, stronger demand than expected, vacancies coming down, rents growing quicker. And that's been building really since that first investment. And when we saw that outperformance, it gave us greater conviction to then grow our portfolio here in the US. We then quickly said, okay, well, this e-commerce growth, which is contributing to this incremental demand, changing this asset class, this is not just a US-centric thing. This is a global trend. Where else could this be happening? We looked into Europe. We built a similar portfolio in Europe. We looked at Asia. We built a similar portfolio up across Asia. And we've watched, how our portfolio has performed and how this trend has continued to develop. And, that growth and that strength in underlying fundamentals and e-commerce growth was there, back in 2019 and pre-pandemic, and only accelerated, over the past 18 months. And our enthusiasm now remains really high because, again, we see what's happening in our portfolio. You fast forward to today, we've acquired about 1.3 billion square feet of logistics space, around the world. And we see from the portfolio that we own today, where that performance is strongest. And you see it in the market stats also. Look at just vacancy as one proxy. We're at record low vacancy levels here in the US. I think it's sub 5%. Look up in Canada, we bought a big logistics business in Canada. I think it's like sub 2% across Canada, and then even lower in core markets. Europe, similar low single digit vacancies. And what you're seeing is e-commerce growth continues to accelerate that sparks incremental demand for space, and leasing activity also hitting record levels in a lot of these places. Just strong tailwinds, and those tailwinds, if anything, even greater than people appreciate. And that's really where we get most excited is where we have a differentiated view. We then substantiate that through what we're seeing in our portfolio, through global trends, through what's happening around the firm. And then that builds on our conviction and leads to even greater investment. And we've done it in a few areas, but logistics would be, I'd say, at the top of that list. It's nearly 40% of what we own. And again, today, when we see that tailwind being as strong as ever, we continue to be really excited. We have that portfolio, we have teams all around the world, we're seeing it real time, and that gives us greater confidence and conviction as we continue to expand in that theme.
Well, another area that it would seem would be at the top of your list, where you're certainly doing a lot of activity in, is single family rental. Could you talk a little bit about your thoughts about that? I mean, like just in over the summer, you guys made so many big moves. Tell us a little bit about that.
Well, I'll hop in and I say rental housing broadly as a asset class, whether it's single family rental or multifamily rental, has been a high conviction theme of ours really for approaching a decade as well. And really that thesis is built around the imbalance of supply relative to demand, particularly for high quality housing in the most dynamic markets in the US and around the world. And so with our investment in single family housing this summer, again, it really was just expressing our view that we think there is strength in this asset class. And what we're equally excited about in terms of our approach to rental housing is just what we think we can bring as far as being a real leader in how we operate. And at our scale, given the resources we can bring to bear, I think showing how you can be both a great investor and deliver results successfully for our limited partners, but at the same time, really being a very considerate owner operator to people in their homes. I mean, again, rental housing is different from other asset classes because it's not just where somebody might work or shop, it's where people live. And so we really lead with a transparent tenant first approach. We have standards of excellence for how we operate in housing that we apply in every situation where we invest, single family housing included. And I think the way we operated through the pandemic is really emblematic of that approach. We have not evicted a single person across the US for non-payment since the start of the pandemic. And we recognize that people were going through, in some cases, very tough times, other cases, just some moments of uncertainty. And we wanted to be there to be a supportive landlord. And we are fortunate to be in a position to be able to do that and we'll have operational support as well to make those kinds of programs happen.
One of the areas that you guys have done, a lot of activity in over this last year, which I was not surprised, but I thought was very interesting, was just you've bought a lot of studios, like Hollywood studios, like movie studio kind of things. Could you talk a little bit about what the thinking was behind that?
Take that one.
Sure. So I'll start. I think you'll hear the words high conviction themes a lot, probably over the course of this conversation. I think it's a good example of how our approach doesn't always start with the real estate. We look out at the rest of the world and what is happening, and how can we apply what we see as mega trends in the way people are living and spending their time and spending their money and invest in the real estate that's going to benefit from that. And what we saw with content, and this really predates the pandemic, we saw that people were consuming more types of content on more devices, and producers of it were needing and wanting to produce more and more consistently in order to grow their subscriber base. And that's everything from Disney and Netflix to things like Spotify. And so we started thinking about, okay, how can we invest in the real estate around this? We bought a large office portfolio going back a number of years that's concentrated in Burbank. We saw the strength of that portfolio, and that really gave us conviction to kind of extend that concept into the studio space directly. What's so interesting about that in particular, it's not just purely, okay, more content demand is leading to more studio demand. Even the way these studios are leased by the major producers is different than it used to be. It's much more like a long-term credit tenant lease, the way you would see in a lot of other more traditional kinds of real estate. And so that kind of transformation of the space use on the back of the demand for the product, really gave us a lot of conviction about this being a very interesting space, and in particular in the markets where we've been focused, quite undersupplied relative to the demand.
Yeah, no, for sure. I mean, it's another great example of, with this, these macro trends and explosion in content creation and that demand that sparks for studio space. And we had this long-term relationship with HPP that ends up being a partner in this investment, and then we're focused on growing that portfolio as well.
Well, it seemed like that the reason why this struck me as a little bit of a different sort of concept was multifamily. Could totally understand the need for it, especially now. Logistics, ditto. That had been a long-term trend for a really long time. But at the pandemic, when everybody was sort of frozen in their homes and there wasn't as much content being created, did that worry you at all as you made these deals, or you're just like, well, this is something that we're long-term believers?
It was more of a long-term, we've seen this long-term trend in growth in content creation, demand for studio space. In fact, content consumption, as everyone was home, was actually quite high during the past 18 months. And we've seen that demand continuing. And since we've committed to that initial portfolio with HPP last summer, and we've seen strength in that sector since then. And actually, we just announced recently that we were expanding that venture with a development in London. As is, this is obviously, again, not just a U.S. phenomenon, to develop a substantial studio complex in London as well. So, we're focused on the longer term trend, and we've seen even through the past 18 months, continued strength and demand for these studios.
Mm-hmm. So I don't know if either of you guys are poker players, but one of the concepts in poker is, do you play your hand the same way if you could see your opponent's cards as if you couldn't? And I am always curious, if you could go back into time to March 1st, 2020, what would you have done differently? Knowing then what we all know now.
Yeah, go ahead. I love this question, even though I'm not a poker player.
I'll try.
It's fun.
I don't think anyone really wants to go back to March of 2020. Let's just start there.
I would have upgraded my Wi-Fi.
Right.
I would have had even more time.
But if we think back to March of 2020 and what we did at the time, I'd start by saying I'm really proud of what we did as a business. I mean, our first reaction, which I think was similar across a lot of businesses, was health and safety of our team, of our portfolio companies, of our tenants across, and making sure everyone was safe, and that's remained a top priority for the business throughout the past 18 months, and then following that, looking at our portfolio, making sure our house is in order, everything was in good shape, and as Kathleen said, we've been through we've been in business 30 plus years. We've seen other crises, not through a pandemic, but we've seen, whether it's the GFC or the dot-com bust or the late 1990s Asia debt crisis, the volatility, and making sure your house is in order, making sure which our portfolio fortunately was in a very, very good position, and then turning to where you could make investments and where there's opportunity. And one of the advantages of that perspective from history is that we've seen in prior periods, sometimes it takes some time for there's a pause in some transaction activity in the market, but the public markets and public securities react quite quickly, and we saw that happen. And where we didn't really act on that in the past, we did act on that in 2020, where the REITs were off 40+%, and we got active investing in some public securities, debt and equity securities. And if I could go back in time, we bought a few $1 billion of those equity securities, so we would have bought even more, right, of that. But I feel really good about the resolve that we had and the steadiness in our business, and then to your point on the past year, getting really active and front-footed as we saw these trends continue. Frankly, reaffirmed our approach to investing and gave us even greater confidence in these key themes. You mentioned logistics, you mentioned residential. Studios is a newer theme, but logistics and residential on their own are 60% of our portfolio globally. And we feel great about that, and we feel great about the other main themes that we've had. And if anything, those were reinforced over the past 18 months. But if we could do things differently, yeah, we would have, I'd say, gotten even more proactive on those securities, even more front-footed on the investing side. And I'm sure there are other things that we would have done, but I mean, the past year was a really proud moment for our business, and one which, you know, like other times, we feel like we've come out even stronger, or coming through even stronger from. I don't know what else.
No, I think you know, Ken said it really well. It was remarkable to work alongside Ken, especially in those kind of very confusing days of mid-March last year, when, you know, as Ken mentioned, at the same time as we were trying to safely shut down assets, send workers home, not just, you know, our own team here at Blackstone, but through all of our portfolio companies, make sure people were safe and cared for. You know, the team was really activating on investment opportunities, particularly in the public markets at that moment. Having lived through this before, and maybe not always having the conviction to know, you know, recognize that deep value and capitalize on it for our investors. And I think that whole method of being able to, you know, continue to focus on the operational work at hand while capitalizing on the new investment opportunities, you know, was just, you know, really how we've operated maybe always. And I think especially it's been highlighted in the last year and a half. And it's really thanks to the strength and depth of a large team we have, and great leadership at all of our portfolio companies as well.
Well, I think I have like only 50 more questions for you, but we actually are out of time. I do have one last question for you that we talked about multifamily, we talked about logistics, we talked about studio. New York office, buy, sell, or hold, like quick one I'm personally interested in that one.
Look, I'd say because the office more broadly, and we can sit in New York City, is one of the areas where it's really hard to paint with I'm not going to punt on the question, but it's really hard to paint with a broad brush, right? And I think it's really important. You know, office has been, I'd say, top of the list in sectors where this work from home and debate on the future of office, right? I'm sure, Max, you've written, and everybody's been writing a lot about the future of office, right? And to me, there's a lot of really interesting areas still to invest in office, whether it's here in New York or around the world. And, you know, if you want to go one end of that spectrum where we're extremely bullish, it's life science office, right? And we bought a business, Biomed, at the beginning of 2016, over 5 years ago, and we immediately saw, the strength of owning these life science office buildings in these hubs of innovation, where you have the universities and the talent and the capital and the institutes, and you can't do your lab work from your desk, right? So you see how these buildings are really essential to the purpose of these businesses, right? And that's one extreme, and that business has performed, there's a spotlight obviously on biotech through the past 18 months. Even before that, very, very strong performance, and we were very positive, but that's only gotten even stronger in our conviction in that space over the last 18 months. Actually, we just announced again in the UK, two major life science developments in Cambridge, UK. One of those hubs. So there's one end of the spectrum on office. We have that, and then there's a lot of high quality office that again, helps companies attract, retain talent, develop ideas, advance their business. I mean, obviously the news of the moment is this Google investment in New York City, and I think that is another example. The right quality building in the right location, and a place like New York where there's huge depth of talent. There's strong demand, and if you read the reasons why Google is recommitting to New York, it's because of that depth of talent and this building and having, bringing people together. I mean, at Blackstone, we've seen, again, really proud of how we navigated the past 18 months, and we did a lot of that in the early months virtually, but huge value, and we're better together. And so putting in place all of the precautions with testing and whatnot to have people back in the office together has been huge. And I think a lot of other companies see that, and office is obviously where you do that. But to me, stepping back, it's also not all office does that, obviously. And there's some, office that, employees feel they need to go to and don't really help, stimulate talent and attract and retain that talent and advance the company's business. So, and I think we're already seeing this, with the higher quality properties and office, and that's really having a very different performance in the current environment, leasing and seeing demand from some of the more commoditized or tougher quality space. So for the right assets, yes, positive on New York City office.
Well, we are out of time, but and that's actually, by the way, a brilliant segue for me to tell everybody to sign up for our new Life Science newsletter. So thank you very much for that, Ken. Ken Kaplan, Kathleen, McCarthy, thank you so much, and congratulations on a wonderful, wonderful year.
Great. Thanks so much again, Max. See you soon.
Appreciate it.
I'm Vince Torrey, head of agency and off-balance sheet lending at JPMorgan Chase. I'm pleased to join this year's Power Gala to present the 2021 Diversity, Equity, and Inclusion Award to the team at JLL. At JPMorgan Chase, we're also working to drive a diverse and inclusive culture for our employees and our businesses. We believe in leaving no stone unturned, covering everything from our recruiting practices, training, to our product and services, and supplier diversity. Last year, we announced a $30 billion 5-year commitment to close the racial wealth gap, drive an inclusive recovery, and support employees, break down barriers to systematic racism. We're always pleased to see and celebrate other firms for their own energy and accomplishments in advancing DE&I. Historically, the commercial real estate industry has lacked diverse talent, and this year's DE&I Award honoree, JLL, has shown a deep commitment to creating sustainable change. Through the implementation of an active D&I program that focuses on attracting, developing, and retaining diverse talent, JLL has demonstrated its focus on transforming from within. In 2020, JLL launched an enterprise-wide strategy to embed D&I more deeply into the DNA of their company, taking the leader-led approach, promoting action on a global, regional, and local scale. In an effort to reduce the financial barriers to entry for brokerage and capital market professionals, JLL launched several programs aimed at making the industry's transaction-oriented roles more accessible to talent who historically might be deterred from applying due to industry compensation models. To date, JLL has invested $4 million to fund entry-level compensation for racially diverse and female sales professionals to supplement traditional commission-based salary models. Building on a long-running partnership with Best Buddies to advance career opportunities for people with intellectual and developmental disabilities, JLL recently signed a $50,000 corporate partnership agreement with the goal of hiring 24 new employees through the Best Buds Jobs program over the next year. The firm also partners with Hiring Our Heroes, Year Up, Changing the Face of Property, Girls in Property, Women in Property, and more. It is my pleasure to present the 2021 DE&I Power Award to JLL.
Good afternoon, everyone. Commercial Observer, thank you so much for this recognition. It's a huge honor to accept the award on behalf of JLL. The social movement events held across the country over the past year have forever changed many things in our society. And quite frankly, within the business world, there's been a demand for a more genuine commitment to diversity, equity, and inclusion. And it has compelled so many individuals and companies, including JLL, to accelerate our efforts to drive change in meaningful ways. In 2020, we launched an enterprise-wide strategy to embed D&I more deeply into the DNA of our company. We began new initiatives and that focus really on addressing systemic challenges facing the commercial real estate sector. We launched and expanded partnerships and university relationships that establish new pathways for diverse talent to connect to our industry and to JLL. And across the company, our people found ways to get involved with charities focusing on supporting communities of color and battling social injustice. This last year was certainly a tipping point in our society, but with the strength and support of our people, provided to each one of us. This has really been truly remarkable. While we are honored to have been recognized with this year's DE&I award, it is equally as important to recognize where we are in our journey and that we, like other organizations, have much more work to do. Each of us has a role to play in how we think, how we run our businesses, and how we show up in our communities. What we know is that the energy behind these efforts is inspiring, and it is clear that we are all in this together. On behalf of our entire team, thank you again for this recognition.
Before I announce our next award, I'd like to congratulate Silverstein Properties for receiving the Economic Recovery Award, Empire State Realty Trust for the Green Future Award, and JLL for the Diversity, Equity, and Inclusion Award. These are four key areas of extreme importance, and each of tonight's award recipients is well deserving of the honor. Our fourth and final category was added this year as we recognize the role that tech and innovation have played in supporting the building industry throughout the pandemic. The Game Changer Award recognizes a key innovator who sought out opportunities to invest in strategic solutions, adopt new technologies, and strengthen the industry at this pivotal time in its history. This year's Game Changer honoree is James Morgan, principal at real estate investment and management firm Morgan Properties. Over the past year, Jason has been at the forefront of innovation, developing strategic solutions for every obstacle that Morgan Properties has encountered. When the pandemic struck, Jason adapted by incorporating new technologies to optimize pre-existing operations. Within days of the start of the pandemic, Jason collaborated with the entire senior executive team to ensure Morgan Properties was well positioned. And Jason encouraged the company to think differently and use the crisis to enhance its management and leasing efforts through the use of technology. He redirected the C-suite team to focus on better ways to communicate effectively with all residents virtually. Jason worked with the operational marketing team to conceptualize, develop, and execute a strategy that ultimately led to implementing virtual leasing tools such as Matterport, chatbots, and YouTube for units and amenity tours. These tools were implemented on all 320 community websites to help prospective residents easily navigate the pages and find the information they needed. It also helps Morgan Properties maintain the same level of customer service and brand identity, even in a largely virtual world. With Morgan Properties' house in order, Jason was able to be opportunistic. In 2020, Jason spearheaded the acquisition of over $1 billion in total volume. In February 2021, Jason also led the company's acquisition of the North Star portfolio, a massive 14,414 unit portfolio spanning 11 states for $1.75 billion. The deal took Morgan Properties to 5 new states, Florida, Texas, Georgia, Louisiana, and Michigan, and established the company as the second largest multifamily owner in the country and the nation's largest private owner. Leading a successful business means more than closing deals and growing a portfolio. Jason cares about positively impacting lives in the many communities Morgan Properties serves and has played an integral part in the company's Caring, Sharing, Giving charitable initiative. The program aims to increase awareness and support for exemplary organizations and causes both locally and nationally. Jason was intimately involved in the planning and execution of Morgan Cares, a recent initiative created to support local hospitals and food banks as they combat the COVID-19 pandemic. Throughout the 15 states where Morgan Properties operates, the company donated over $475,000 to local hospitals and food banks that served on the front lines during the pandemic.
Hello, my name is Jason Morgan, and I'm a principal at Morgan Properties. Morgan Properties is the nation's largest private multifamily owner with a portfolio of over 90,000 units and $15 billion in assets. I'm honored to have been selected for the Game Changing Visionary Award. The past 18 months has truly tested all of us, and I'm proud of everything that Morgan Properties has accomplished. Initially, we went into a full court press to make sure all of our properties were clean and our residents and employees were safe. Once proper COVID-19 protocols were in place, we expanded our company's war chest and immediately went on the offensive. We've closed on over $3 billion of transactions since the start of COVID and truly didn't skip a beat. Our company has leveraged off of technology in different ways than ever before, and we have emerged from this crisis stronger. We are able to continue to grow our portfolio only because we have the best and brightest people in the industry. This award is a recognition to all of our efforts. Thank you to the Commercial Observer, and I am proud to be included in such esteemed company.
Hi, Ken. Thanks for taking the time.
Thanks for having me.
This is one of, if not the last virtual interviews we all have to be a part of.
Amen.
Appreciate your time today, but hopefully next time I don't have to straighten up my desk for an interview. A couple questions here for the lightning round. How has Fisher Brothers adjusted its strategies during the pandemic, and how have they adapted to the shifting paradigms?
Well, we had actually started to reposition our portfolio before the pandemic. One of the things that we had planned to do before the pandemic hit was actually install a UV light system into the HVAC in order just to have cleaner air for our tenants. And the byproduct was the fact that it had a 99% kill rate on the COVID. So in addition to that, we modified the building some more for the COVID with the Bluetooth technology, increased outside airflow, went to a flow consultant to figure out what the best way to move people, around the lobby and in and out of the building, not just one way in, one way out. And the other things that we're doing are just a kind of an ongoing updating and improving our BMS system and install the fiber backbone in all of our properties. So, it's been a repositioning, and then the repositioning had to be repositioned to keep up with the COVID.
Speaking about your tenants, what do you find that they're looking for from their office space and the landlords as now they're returning to work in greater numbers?
Well, right at the time of this interview, we are running 23% portfolio wide on the average. I think tenants are coming back wanting to know that they're safe, first and foremost. We actually put a website in place for our tenants to access so that they could see what we were doing on an ongoing basis, keep up with what we were actually doing, and let them know that the buildings were safe and ready for their occupancy. So we have been ready since, almost a couple of months into the COVID. We were ready to have people back.
Yeah. You mentioned 23%, Ken. Do you know how that compares to the overall percentage of folks that are back in their office space, at least here in the New York City market?
I don't at this point know. I know that it's probably fairly similar.
Yeah.
Depending on the tenant use, in each building, and I know that financial services are coming back, in greater numbers, and we've seen that in our portfolio. But at this point, what was supposed to happen in Labor Day moved towards October, and then it got moved to the end of the year. So everybody's kind of varied in terms of when their comeback is going to be.
Yeah.
But we're ready.
Well, thanks for articulating what the landlords need to do. What is your view that the city needs to focus on in order to get more companies back to work on a regular schedule?
Well, they've got to convince everybody that mass transit is safe. It's safe to take, it's safe to benefit from. As we all know, the city has increased the number of bike lanes. So people will be riding bikes, I think, in greater numbers. When the weather turns cold, that's another story.
Yeah.
But I think in general, I think the city, from a get back to work standpoint, I think the number one focus that they're going to have is the mass transit and making sure it's safe.
Okay. What do you see as some of the key components of the city's economic recovery?
Well, I like what I'm hearing out of Eric Adams. I think that's very positive. It's been very positive. I think New York has to reconcile with the fact that, we are losing businesses to other cities. And right now, New York may not have the best aura around it, if you will. And I think the number one priority is that the administration, whether it's current or future, is going to have to show tenants that are potentially thinking about relocating to New York that this is a pro-business atmosphere. I think that's probably one of the most important things, so that people don't get the sense that Amazon is the way we conduct business. I think that's important. I think an acknowledgement of the fact that we did lose people, and we need to get these people to come back. So, raising taxes and so forth, and that kind of a plan, I don't see as conducive to the economic recovery of the city. I think the number one focus needs to be how to get businesses to come back to New York, how to get people to come back to New York.
Makes sense. Are there some trends from the past year and a half that you think will be fundamental shifts in how we view real estate in general? And are those long-term and here to stay?
I would assume that one of the things that we're talking about here is remote workforce. And I personally, while I think it's here, I personally don't believe it's a long-term. I think that there'll be a component of the workforce that remains remote. But I think us baby boomers we enjoy having people in the office. We enjoy the collaboration. I personally enjoy walking from office to office and having impromptu meetings. So whether or not the remote workforce stays remote, whether it's a short-term thing or a long-term thing, I can't say at this point. But personally, I think it's maybe 3 to 5 years.
Yeah. And what about your view on the way that offices are configured in terms of spacing and the way folks kind of lay out in the open bullpen type environment?
Well, we went from a fundamental shift away from, all of the offices to more open collaborative space.
Yeah.
And now we've kind of shifted away from that. So, the kind of co-working, design for, offices and businesses as a whole, I think is going to move. We're going to move away from that, maybe back into some more offices, or to have greater spacing between people. How much spacing, I guess, will depend on how many people are kept remote. But I think the overall design has shifted away from the co-working kind of collaboration to a more traditional, say, office usage.
Yeah, that makes sense. What are your top priorities for the commercial real estate industry in general, and more specifically, the key markets that you operate in?
Well, I think, we do our part. We are doing everything we possibly can to get people to come back. I think that's the number one focus, is getting people back. The economy will benefit from that. I think business as a whole will benefit from people coming back. So I think that's our primary focus, is getting people back, getting people convinced that the buildings are safe, because they are. We've actually taken great pains to show people, what the actual airflow is, how clean the actual air is. We continue to upgrade our properties from a sustainability standpoint. So we're reducing our carbon footprint. We've actually even gone, taken some steps to increase diversity. We're working with BASTA right now with an intern program that we're very proud of. So I think it's a whole combination of things, but I think the number one thing is get people back.
Yeah. Insightful. Were you opportunistic, and did you take advantage of portfolio expansion during the last year and a half?
Well, not in the sense that we bought. I think what we did was we completed our repositioning. We have some leasing that we have to do. We've had some robust deal flow, which we're very happy with. Some of it was a little unexpected, but we're very pleased with the amount of deal flow we have right now. So for us, opportunistic was taking into account what's in front of us, not just from a valuation standpoint in terms of buying, But we also in the last 2 or 3 years developed in Las Vegas, which my cousin Winston was instrumental behind, was the Area 15 immersive mall retail experience, which is really doing well. We're very proud of it. We're expanding now into other cities. So in that sense, we were opportunistic. We continue to look, but at this point right now, my number one focus is making sure that the portfolio gets rented and stays there.
Okay. Well, thank you. This was very promising, optimistic, and insightful. Appreciate your time, and I think that concludes the lightning round.
Great.
So thank you, Ken.
Thank you very much, guys. Appreciate it.
Take care.
We are here today for our fireside chat with a true legend in the industry, RXR's Scott Reckler. We're very honored that you joined us, Scott. How are you today?
I'm doing great, Max. Thanks for having me, and I'm looking forward to our chat today.
Yes, me too. So I wanted to start, so there's obviously a lot to discuss about how the last year has shaken out. But the first place I wanted to start was there had been a lot of talk about exodus to the suburbs. You have, projects in, New Rochelle and Yonkers. How did the exodus to the suburbs shake out in your view?
I think, as you mentioned, in the beginning, there was this, on the residential side, right, there was this exodus out of the urban center to suburban areas. And then there was followed by some of the larger companies talking about, do they put large satellite offices around the suburbs? And I think as well, that was an initial reaction. They quickly sort of put pause on that and said, let's see how things unfold. And I think what we've seen longer term now is that people are viewing city centers like these super regionals, these super cities, superstar cities like New York through a regional lens. That if you're going to be competitive, you have to think about how do we create outlets of housing and lifestyles that creates a quality of life and affordability and flexibility for their workforce more regionally. And so we're now seeing companies, as they think about returning to office and having remote work, not necessarily be remote work at home, but having smaller satellite offices in locations that are in the downtowns where people are living, where they then can actually be closer to their home, make it to do things with their kids or run errands and not have to take the commute in a day or two a week, but they don't actually have to work at home, because there's a challenge for a lot of people to be able to work at home and focus. And you also don't get that sense of being part of a company and all the resources and technology and security that goes with that. So I think the byproduct of this is there'll be satellite offices. I think there'll be smaller satellite offices, but I think the bigger message is that there's going to be these superstar cities that are going to combine superstar regions, and there's going to be a much more integrated approach as companies think about their expansion plans, not just in the city core, but also how much support they can get from having a region that has affordability of housing, character, downtowns, quality of life, and most important, public transit back to the city center.
Is that something that you guys have been integrating into your planning in some of your, some of the like planned communities that you guys have been building?
It's, for us, we've been doing this for 10 years, right? In terms of looking outside of the of Manhattan to be able to create New York City quality housing that is 30 minutes to 40 minutes away from Manhattan by public transit, but is 30 to 50% less costly than renting in Manhattan, and going into some of these downtowns, suburban downtowns that over years have become filled more with parking lots, so they're long on parking lots and short in tax revenue, and working with those municipalities to help develop master plans to help revitalize that economy and position it so it can be a asset for the region and for that local community going forward. And I think COVID has accelerated that, right? COVID, while we were doing that before, COVID accelerated that trend. So we've seen great demand in our multifamily product in those areas during COVID and post-COVID. But what I don't want to leave with is that in terms of the flight to suburbs, since January there has been a tremendous flight back to the urban environment. I mean, if you look at multifamily leasing, month after month after month, we're seeing a record level of leasing, and the stories went from concessions to landlords giving away apartments and low leases for 2 to 3 years to now people having to snap up leases, free apartments when they come online or they lose them. And so, the talent has already, migrated back to the city. And even if you look at public transit on the weekends, even you're seeing like at Long Island Railroad and the Metro North around 70% of ridership compared to where they were in 2019. Yet in the weekdays are like 40%, right? So people are coming back to the city to live, to play, to be engaged. They just haven't yet come back to the workplace, which I think is really because of the Delta variant and some more global decisions by some of these international companies.
Well, we are also seeing some leases in Manhattan. There have been some moves made. What are your thoughts about that? I mean, it seems like it's been a select few buildings and select companies that have actually been making moves, but there's been, you said flight to the suburbs, flight to quality as well in terms of Manhattan
Absolutely.
real estate. And, tell me a little bit about your thoughts on that.
We've definitely seen an uptick in leasing. I mean, actually, July, I think, was like a record level since 19 in terms of a monthly activity. We've seen in our portfolio, our peers have seen it. And I think it's even more than the statistics are showing, because if you look at the number of companies that are out there today in the market looking to either take advantage of flight to quality, B, look at this moment in time and they have a renewal that's coming due in a year, 2 years, 3 years, to say, I could buy value today if I make that commitment today to do that, or they're just expanding, which is a lot of the tech companies and healthcare companies that are expanding. And so, we're seeing a lot of activity. And I think, if it wasn't for the Delta variant, I would have thought the fourth quarter, we would have seen a lot of what we're seeing under the radar screen flow its way into the statistics. My guess is now in the first quarter, we're going to see that. And there'll be, I think, a psychological shift in terms of this landlord-tenant dynamic of tenants coming back and the high quality space in the market starting to move at a much quicker pace. And I think the distinction, to your point, is it's a flight to quality. I mean, if you look at the numbers, I think the latest stats I saw were that the activity post-COVID has been about 85% Class A buildings, only 15% Class B buildings. And even within Class A buildings, the newly renovated or newly developed Class A buildings, rents are at like 50 to 60% premiums to what Class A overall rents are in that marketplace. So that really demonstrates that flight to quality, and it's a have and have not market. And I would argue that in this post-COVID world, that if you don't have a Class A building that's close to public transportation, has the right infrastructure, has the right level of amenities and workplaces and engaging in institutional ownership, it's going to be challenging, and you'll have a level of competitive obsolescence that's not really about what rent you're going to charge. It's going to be people aren't going to want to go to those buildings, just like you see with Class B malls versus Class A malls. And so I think there's going to be this divergence, which are going to leave a lot of buildings empty, and hopefully we'll use good public policy to accelerate the conversion of those empty buildings either into new Class A office buildings or multifamily uses to provide more housing in the city.
It also seems like it's something happening geographically. So you are, right next to Grand Central with like at least 2 projects that I can think of. One of the things that I've been sort of amazed by as just an observer of it has been the numbers that One Vanderbilt has gotten for some of its leases over the last year. Do you think that like Grand Central is a hub with all the new transportation upgrades that are going on there? Is that more important? Also talking to some of the transportation issues that you mentioned earlier.
Yeah, right. I think, listen, Grand Central, obviously, we're big believers. We have 5 buildings in Grand Central. It's the largest concentration of our portfolio after Rock Center, and followed by Rock Center. And it's to your point, right? Transportation's key. People want to be able to get to work easily. There, in Grand Central, you have the current, transit system, but in 2022, we'll have East Side Access open, which are people, I'm not sure, really appreciate that you have a whole nother Grand Central, 8 tracks being built underneath the existing Grand Central. That's gorgeous. That's going to open up and really be, a great asset. That's enabling also people coming from Long Island to end on the east side versus having to go all the way to Penn Station if they're working in Grand Central. So that's a key thing. The other thing was the east side rezoning policies really have done a great job of achieving what it was meant to achieve. And it shows you when good policies put in place, it actually drives outcomes, right? So, by encouraging new development of new buildings in Grand Central, you have JP Morgan's headquarters, you obviously have One Vanderbilt, as you spoke about. We're in the process of finalizing approvals to build over the Hyatt Hotel, a 2.5 million square foot office building, and have 2 large tenants that we're having conversations with to be the anchor of that at rents that you would say, wow, even in this market, it's happening. So it shows you that people want to be there, and success begets success, because with these new buildings, then there's more activity, there's more energy, there's more engagement, more restaurants, more public spaces, and we're all investing in infrastructure. Like SL Green, they invested, I think, over $200 million, maybe $250 million in the infrastructure they put in for the subway. We're investing $400 million to expand Grand Central and subway access underneath our building next to Grand Central, right? So it's doing what it was meant to do, that policy, and I think it's a good reminder for us as New Yorkers that, well thought out policies that can encourage private sector economic development that invest also in public sector infrastructure are win-win-wins. And it's got to be the way that we focus on our future. And that was my point about now thinking about empty office buildings or old empty hotels. We need similar policy to create the right incentives so that the private sector comes in quickly and helps convert them into uses where there's demand, because it does none of us any good to have parts of our neighborhoods with empty buildings that are in bad shape, that then the retail can't survive and crime occurs around there. You need to bring them alive with product that is more meaningful. And we saw that in Lower Manhattan post 9/11, right, where it went from just a commercial 9 to 5 marketplace to a 24/7 live, work, play community with a mix of office, residential, schools, parks, amenities, restaurants, et cetera. And so there's a formula how you make these ecosystems work, and public policy can be the driver of that formula.
No, for sure. Well, by the way, Scott, as a reporter, I have to ask, you're not going to make news and tell us who those anchors are, I take it.
No.
But I'm going to be bugging you a lot in the next couple of months. I wanted to, we've only got a few minutes left. I did want to get to what you think the political shakeup in Albany means for real estate. Andrew Cuomo was obviously a real big believer in development. He was he put a lot of his political capital and other kind of capital into this. What do you think of Kathy Hochul?
Yeah, so I think Governor Hochul is in a unique position, and I think as it relates to real estate and the big projects and the infrastructure projects that were on the boards before, she was very much involved in. She was the head of the Regional Economic Development Council, so she was the chairperson all around New York, upstate, downstate. And so in all these big projects that people were competing for state funding on, she was intimately involved in that. And from everything that I've seen and in my conversations with her, she's going to be moving forward with these transformative projects. The other thing I think that is a positive with Governor Hochul is that she's very focused on collaboration, and so she's been actively engaged in discussions with Mayor de Blasio and some of the challenges as we're reopening. She's been actively engaged with Eric Adams, the likely next mayor, about making sure that we deal with the perception of public safety, more police on our streets, deal with the homelessness issue. And so where I think, if as a transition, if you think as Governor Cuomo did an extraordinary job, I think, navigating us through the crisis of this pandemic and leading us as a state and a country, where Governor Hochul, I think, has an extraordinary position is leading us to the post-pandemic recovery and enabling us to coexist with COVID and invest in capital and in the capital projects and communicating to the private sector and the public sector and forming that, that level of collaboration and vision for what that will be.
Now, we only have a couple minutes left, but I did want to just find out, obviously, RXR has a lot of irons in the fire. What is going to be your main focus in 2022?
Yeah, so, we can't ignore that the world after COVID is very different than the world before COVID. And, as we look out there and we say, there are clear mega trends that are going to drive, the economic growth. And so we've been shifting our strategy around those mega trends, right? So obviously e-commerce and same-day delivery and streaming videos has been key. So as we just are finishing a 1.3 million square foot building for Amazon in Maspeth, Queens. So last mile delivery logistics is an area we've signed the contract in Red Hook for another project that we're in the process of designing right now, similarly like that last mile logistics. Same thing for streaming video and content production. More and more of the studios want to have locations in New York closer to the town. So that's an area that we're going to focus. Second area is this housing. How do you create affordably priced, non-regulated housing so that this city that's magnetic, attracts talent, can create affordable alternatives for them to live in the right quality of life? And so we're going to continue to lean into that. Over this last 12 months, we bought $2 billion of multifamily in the New York metro area. So we saw this dislocation, we jumped on it. It was about 80% occupied. Now it's 95% occupied. We're going to continue to do those types of deals. And the third area is healthcare, right? I think we've all recognized that we woefully underinvested in our healthcare. So we're working on some virtual care projects, some public-private partnerships, healthcare institutions, life sciences are areas that will grow. And I think strategically, two areas that will sort of overlay all of that. One is looking at competitively obsolete product, whether that's malls, office buildings, hotels, and thinking about how we can repurpose them into a product that falls into the crosshairs of that mega trend demand that I described before. And the second is keeping a close eye on inflation. And we've seen inflation playing out in a lot of our costs, both operations and construction. As we talk to our tenants, they're all seeing it in their businesses. So investing in areas that are hedges for inflation and positioning ourselves that if there is a strong inflationary environment, that we're well protected and can benefit from that.
Well, Scott, I think we're out of time, but Scott Reckler, thank you so much for being with us.
It's always a pleasure. Thanks for having me, my friend. Be well, Max.
Be well. I'd like to thank you all for joining us tonight at our 14th annual Power Gala. Thank you to this year's honorees and speakers and our program keynote speakers, Larry Silverstein, Marianne Ty, Kathleen McCarthy, Ken Kaplan, and Scott Reckler for making this such an engaging and memorable event. I'd like to extend a special thank you to the 2021 Power Gala sponsors, including Silverstein Properties and program sponsors Accenture, Ackman Ziff, Acor Capital, Burden LLP, CIT, Columbia Property Trust, Cushman and Wakefield, East Still Secured, Himmel and Marengoff, Hines, JLL, JP Morgan Chase, Kensington Vanguard, Latch, Mac Real Estate Credit Strategies, Marks Realty, Related, RXR, Savills, Signature Bank, and Starwood Property Trust. I hope you all enjoyed the program. Please be sure to take a look at our events page on our Commercial Observer website, as we have an exciting and busy fall calendar lined up. I hope to see you all at future events. Have a great evening.